Good afternoon, everyone, and welcome to the 2025 Women in Fixed Income event, Will the Path to Normalization Be Sustained? I'm Erin Lyons, the president of FIAZI, and I'm delighted to welcome you to our 7th annual Women in Fixed Income Conference. This is our second year partnering with the New York Fed, so thank you again for having us. I had to get my pictures to send to my parents again to be here. And I hope those that were able to participate in the museum tour found them as fascinating as I did last year. Here's hoping that next year we can see the gold again, which is a highlight. Each year I'm continuously impressed by the remarkable lineup of speakers we're privileged to hear from. Distinguished experts in their fields who also happen to be women. And it's been a really important pillar of putting this conference together to highlight this wonderful talent. We're honored to begin with opening remarks today from Anna Nordstrom, the interim head of Markets Group and head of Domestic and International Markets at the Federal Reserve Bank of New York. Following this, we have an exciting fireside chat with Nancy Zimmerman and Monica Aggarwal. Our first panel will explore what lies ahead for the global economy and markets, which I think by the day is becoming an even bigger question. After a networking break, we're going to reconvene for our second panel, which is entitled Driving Retention Through All Levels, Current State and Looking Ahead. And we'll conclude with a discussion on trends and outlook in private credit. I think we all know private credit is something everyone is trying to figure out. To wrap up the day, Julie Remache, Deputy SOMA Manager and Head of Market and Portfolio Analysis at the New York Fed, will deliver our closing remarks. Before we begin, I want to extend our heartfelt thanks to everyone who made this exceptional event possible. The New York Fed team, Anna, Julie, Ann, Maylene, and Connor, thank you for being such wonderful partners. FIAZI is really lucky to have developed this partnership with you, and thanks. And a special thanks to Joyce Chang. So Joyce has been the visionary behind this event since the beginning. And it is due to Joyce's really hard work and not to mention her connections to be able to pull this out every year. So Joyce, thank you for, again, being so dedicated to FIAZI. And to everyone, we really appreciate you being here today and supporting FIAZI's mission. And here's to an inspiring and insightful day. So I'll turn it to Anna.
Thank you for the introduction, Erin. So good afternoon, everybody, and welcome to the New York Fed. It's a pleasure to speak to you all at FIAZI's 7th Annual Women in Fixed Income Conference, and we are very excited to serve as co-host again this year. I have found this forum to be an excellent opportunity for us to engage with one another on critical and substantive questions at hand in fixed income markets and in financial markets more broadly. Last year, I enjoyed participating in the panel on expectations for fixed income markets in 2024, and I'm very much looking forward to hearing the panel's plan for today. So please note, though, that the views I express today are my own and do not necessarily reflect those of the Federal Reserve Bank of New York or the Federal Reserve System. So as interim head of the Markets Group and head of the Domestic and International Markets function, I'd like to take the opportunity to highlight the importance of the bridge between the work we do here on the open market trading desk and the engagement that we have with market participants through various types of forums, including events like this one today, and how that connects with our mandate to implement monetary policy. A key focus of the Markets Group is to act as the eyes and ears of the Fed, dissecting market signals on the outlook for interest rates and assessing potential implications for broader financial markets. As SOMA manager Roberto Perli highlighted in his remarks last September, we collect market intelligence through various approaches. These include structured outreach, such as the survey of market expectations conducted before each FOMC meeting, regular outreach to market contacts, and sponsorship of industry committees, such as the Treasury Market Practices Group, the Foreign Exchange Committee, and the Investor Advisory Committee on Financial Markets. To ensure that our market intelligence is robust and reflects the full range of perspectives across market players, we actively focus on building and developing relationships with a broad set of investors and market participants, with a particular focus on the markets in which the New York Fed operates. Our interests cover a breadth of areas, including expectations for monetary policy, financial conditions in the US and abroad, and also for financial stability. We also focus on market structure and liquidity, as this is very important for understanding market dynamics. So the flow of information in these meetings is one way, and desk staff do not divulge any information from the Fed as part of these outreach efforts, nor do they share what they hear from one market contact with another. So effectively parsing through these interactions alongside the data we have at hand, Markets Group staff synthesize timely information in a wide range of briefings, analysis and tools to help inform policymakers, other senior stakeholders, and staff across the Federal Reserve System and the US Treasury. In addition to providing analysis and insight to help inform policymakers and supporting the development of policy, the Markets Group also implements policy and conducts a wide range of operations in global financial markets. The insights that we gain from market intelligence on market dynamics, innovation, and the evolution of market structure and technologies is essential to effectively implement monetary policy. This includes everything from our daily repo operations, which Julie Remache will discuss later today, to understanding and providing liquidity during periods of elevated market dislocations. So leveraging our robust insight into financial markets, Markets Group staff have been key drivers in the design and operation of emergency liquidity facilities critical to stabilizing the US financial system and the broader economy during periods of elevated market stress. Design can only go so far without the right tools. So as markets and technology evolve, we too must transform our infrastructure and platforms for execution. And this includes ongoing transition to FedTrade Plus. This includes, so in FedTrade Plus, we recently successfully tested and executed some small value exercises, and we received positive feedback from market participants, from our counterparties participating in these operations. So this is only the first step in transforming the way that we work, strengthening our ability to be agile in the fast-shifting environments in which we operate. So as you can see from the examples that I've highlighted, the insights we receive from this ongoing dialogue flow through all the vital aspects in central bank policy implementation. The discussions we will have today not only illustrate the depth of market intelligence we can glean from events like this, but also demonstrate how the distinct views and perspectives we each bring to the table ultimately strengthen our ability to operate effectively and resiliently, even in times of great uncertainty. I look forward to personally hearing the panels today and your views and perspectives. So I am grateful for the excellent slate of presenters and panelists for the event today. And I'd like to highlight some of my colleagues and leaders from the Fed who will be participating this afternoon. So Rebecca McCaffrin, Director of Cross-Market Monitoring and Analysis on the macro outlook. The Markets Group Chief Product Owner, Amanda Weinberg, on talent retention. And Fang Tsai, Assistant Director, Board of Governors on private credit. And Deputy SOMA Manager, Julie Remache, who will be closing out the event. And now I'm happy to turn the mic over to Monica and Nancy for our keynote fireside chat. Thank you all.
So good afternoon, everyone. I'm Joyce Chang, Chair of Global Research and on the Board of Directors for FIAZI. And I also just wanted to start by just giving a huge thanks to everybody at the New York Fed for hosting us. You know, when we first started doing this Women in Fixed Income event, it was 2015, and there were only 5 people. And to have really grown this into a registration that had more than 400, including the online, to be able to host it at the New York Fed, which stands for so many of the common values that we share: market stability, transparency, a commitment to excellent research, and to also just be able to share best practices has just been amazing. And I have to really give a very, very special thank you to Julie Remache in particular, to Ann Chen, and to Maylene, as well as Connor, for just sort of staying with us and inviting us back for the second year to be able to co-host this. It's just been such a privilege. But I'm really pleased to introduce the Fireside Chat today, because 2 people who are just real inspirations to me. So Nancy Zimmerman, who I've known my entire professional career, but she's truly a pioneer in the industry. She has one of the longest standing excellent track records of any man or woman in the hedge fund industry, having started her own fund in 1994, with a 30-year track record after leaving Goldman Sachs. Monica Aggarwal, who has been an anchor for the Fixed Income Analysts Society. She's now the secretary, she's been the president, but just really committed to education in fixed income across many disciplines. She is the team head of retail and consumer for Fitch, but before that was an equity researcher at Morgan Stanley. And you're gonna see there are these little alumni clusters of former Goldman, Morgan Stanley, former JP Morgan people, but we've all stayed very connected with each other. So let me turn it over to Monica, and thank you so much, Monica and Nancy, for coming and sharing your story.
Great. Thank you so much, Joyce. Thank you, Anna and Aaron, for your kind words, and welcome, everyone. I'm so excited to be speaking today with you, Nancy, co-founder of Bracebridge Capital. We're really looking forward to hearing about Bracebridge, how you started your own firm, your career. And I'm personally very excited to move out of my US retail consumer lens and hear about your macro views and financial implications for the global markets. So maybe as a way of background, I think Joyce had already covered that you started your own firm in 1994 after spending time at the Chicago Mercantile Exchange, running the interest rate options at Goldman Sachs. And so can you tell us a bit about Bracebridge and what prompted you to start your own firm?
And it's also funny to look way back in the rearview mirror. It's like so fun to be here and to be at this moment with all of you guys. Like a great vibe in the room, and it's fun to see all these friendly faces and to make new friends. Super excited to be with you, Monica, and to get a chance to meet new people. And I think we're always making our networks denser. And so it's really fun to be here today and have a chance to do that, especially when there's no shortage of topical things, that it's really useful to hear what people you don't know think, because you pretty much can guess what the people that you know think. And so, I try to go back in the Wayback Machine to how I wound up in this business in the first place, which is I worked at a place called O'Connor & Associates, which was a option arbitrage firm, and they had operations on a lot of exchanges. I came to them as a summer help. I actually got the job by accident. I didn't have the place that I got a job had gone out of business. It was an art gallery before I got home for the summer, and I came from a family where you had a summer job, and somebody introduced me to somebody, and I got a job at O'Connor running around messages and stuff. And it was like 1983, and so they're just involved in inventing the PC and all this stuff, and I could program an arithmetic average and a geometric average in a shark, and so they thought that I was a genius. And I was busy doing arbitrage between the Kansas City value line and the OEX, okay, just so I can completely date myself. But these guys were incredibly nice to me and real mentors, and I had a really great experience. Then there was a stock market crash. I don't know if everyone knows about that. Sometimes the stock market goes down. And so in 1987, the stock market did go down, And O'Connor was much more of an equity place than a fixed income place. And Goldman made me an offer to try to unify their market-making operations worldwide in fixed income options. And so I went there, which was the start of really my world becoming much bigger. And it was really, really interesting. I spent time in New York, I spent time in London, I spent time in Tokyo. At some point I was in Tokyo with a bunch of 45-year-old Japanese guys reporting to me, which is a little bit of an adventure that I can still tell stories about. But I'm friends with some of them, and then I trained some of them. A guy, Eiji Ueda, has made an enormous difference in Japan running their pension fund after being at Goldman. So like, your world works in enormous ways if you're open, like strange, unbelievable ways if you're open to it. So after that, I was at Goldman. I probably spent half my time proprietary trading. It was before it was against the rules. You know, I realized that's what I really like to do with my time. So I wanted to really distill I wanted to spend more of my time in markets, taking advantage of market inefficiencies. And I assumed that there would be somebody who had a strategy that was market neutral, like duration neutral, and beta free, that would allow people to capitalize on these inefficiencies, get a stream of alpha, and take that alpha and put it together so that you could diversify without giving up expected return, because something that's not correlated to stocks and bonds is really useful for portfolio construction if the market ever goes down, which I know that's not really what happens anymore. But so I went out and looked for that in the world, and I could not find it. Mostly what I found is that people who did RV, micro RV, any kind of anomaly exploitation, on the side, they like to guess which way interest rates are going, that they thought that they were that they had insights. And I do see how it could happen because you're there and you see the whole story. And but I don't think it's a really great combination because the risk management techniques that you use for doing RV are very different than the risk management techniques you do for macro. It has made it so that I've had a very dispassionate, almost disassociated seat at the macro world, like in macro world, so that I have a lot of friends who do have macro stuff, and I've been involved in a lot of really interesting conversations. And I do think for doing anomalies, it is important to kind of understand where they come from. So that's been good for the strategy itself. But I really wound up starting this thing because I couldn't find somebody who was doing it. So we went around, and I was trying to find like a person who did this, and eventually someone sent me to David Swenson in New Haven at Yale. And I said, so David, like, everybody, somebody introduced me. Actually, I think Tom Stiers, who introduced me to him, or maybe David Cohen. And I said, so who does this? And he said, no one. They all punt around on the side. And I said, and he had been at Lehman. I think he was the grandfather of the swap. So he understood that we have these strange anomalies where, like, if you take a corporate bond denominated in Europe, swap all the cash flows, it'll be different than the discount rate in dollars. And that there are, because fixed income is very mathematical, over-specified, there's a lot of inefficiencies, some of which go away at some time, some of which come, certainly. And so he said, this would be a great strategy. We'd love to do it, if somebody, and I wound up, with Farallon doing my back office and legal and marketing, and with a few initial investors who were super supportive. And it was a journey. Like when I started out, I definitely could price anything, but I wasn't an investor. I was like a person who could figure out what things were worth. And it probably took us a few years to become investors. But it's been a lot of fun, and we've had a lot of I've worked with a lot of fun people who are still with, and we've had a lot of fun. So it's been really great team.
There must be so many interesting stories and experiences along the way. I guess, what were some of the barriers that you faced when you were starting out?
Look, I think everybody faces a lot of barriers when they're starting out. I think we were a little bit blind and impetuous to them, and that was helpful to us. So I think that one thing that I think is, been helpful to me is just to kind of ignore the noise and try to figure out how to navigate a speed bump that you actually is in front of you and you're going to have to take, rather than worry so much about all the other things that are really not happening or are happening to other people, and to just do the thing that's in front of you the best you can. And I think it's always, I think it's going to be difficult anytime you decide to do something small in a world where there's a lot of big people doing big-ish things. But I do think that for what we do, it's super important to be aligned with our investors, stick to our knitting, and to do exactly what it is that we're doing. And that thing isn't easily pasted onto something big that either collects all the assets in the world or is part of something that has a different central purpose. So it's been really good for coherence and integrity, like just the intellectual integrity of the product, to be, our own, to be small and nimble.
Yeah, I feel like sifting through noise has become the name of the game. There's a lot of noise. But anyway, if there was anything, if you could go back in time and there was anything that you would tell your old self about, investing or just starting a firm, are there any takeaways from that?
That's an interesting question. I think that, we always try to think about our past selves. And I think that the world our past selves lived in is also gone. Like, this is a great moment to be alive. And so, I think I was born at a great time, but this is an even better one. And I think it's always important to be technology is just going to do great things for you. You just have to be open to it. And I think it's really, you shouldn't be blind to opportunities. They come in all kinds of packages.
That's fair enough. So with that, focusing on the current, let's turn to some of the macro, outlook and investment implications. We're obviously witnessing inflation, high interest rates, massive deficits, deglobalization and quantitative tightening. And so the next 10 years could look very different from the past decade. So I know you're an RV-focused investor, but do you have any thoughts on the potential major changes that we could see coming down the pipeline in tax spending as well as regulation?
I think that from my vantage point, I think the important thing to think about is, how is all this stuff still hooked up so that you can think about how the gears turn and that they are still, gravity is still going to intervene. And so we just need to really figure out how to what's the horizon. And so there's some of the things that we do when we manage risk to think about, what's the horizon of this? Who's involved? Why is this happening? Is it mispriced for a reason? Are there stakeholders? Is there some force of gravity that is going to bring it back? And to try to figure out what's the catalyst? What is going to make this stop or go forward in a way that would be, you think, more interesting? And so I think that in a lot of things at the beginning of, at the beginning of a presidential term or when we have changes, there is a lot of excitement and trial balloons and things that go on, many of them very helpful for having a broader conversation as a society, but some of them are intractable, and I think kind of quite obviously so. And so I think that as we sit here and try to figure out exactly how did we get here, what can we do? So what we should do as a society has to be a proper subset of what we can do, right? We can't, there's just a lot of stuff we can't do. And so I think it is interesting for people to widen the aperture and to think about a broader spectrum of what can we do. We shouldn't just say, oh, we can't do that, we can't do that, we can't do that. There may be a bunch of things we can do that we haven't considered doing before. But, we have to be able to actually do it for it to be something we should do. So, I think that's, for me, a really that's kind of grounding and helps me think about, well, what's really going on here? Because, you know, there is a lot of stuff that is, especially right now here, reminds me of just when I think about other times and other moments and other markets, like the kind of thing that go on. Like just something simple like, let's revalue the gold, right? Which it just comes up for you because you're in this storied moment, in this storied place. But, you know, how would that work, right? Would we just emit the money? Like, that probably is somewhat inflationary. Like, what would happen then? And sort of just getting back to basics that everybody in this room really is into, like, okay, let's just imagine I'm sitting, it's 1984, I'm sitting at Brown University at a desk, someone hands me a blue book, and they ask me to write what's gonna happen if we revalue the gold, okay? And why would it be so different then? And I think we do need to get back to those basics, and that's why it's exciting actually to be around people who are like analytic and think about fixed income and how do the gears move.
Great, thank you. I mean, I think in some of your remarks you were talking a bit about, you know, market anomalies and, you know, where do you think some of that comes from?
You know, we spend a lot of time trying to figure out about, like, is it arbitrage? How long will it take? Where's this anomaly coming from? I would say that a bunch of anomalies come from, you know, over-specification. The first 2 years of the yield curve has a lot of instruments, and if there's no one to police them, then they can be anywhere at all. I think when central banks are in the quantitative easing mode, then it becomes their natural job. When they're in the quantitative tightening mode, it's no longer their natural job. And we, of course, need to think about, are there structures that we want to have fluid and, you know, markets that are a bit more efficient in treasuries? But then once we get outside treasuries, it's really nobody's business, right? So there's just no force besides the end user to make, you know, the PEMX 31 and the PEMX 32 have the kind of yield you'd expect by doing a spline. And then when we look at things that are even more complicated, like PEMX versus the sovereign, then you have like real anomalies that happen because of things like habitat, rating agencies. You know, EM is like a very funny place because you have a very, you know, you have a $4 billion, $4 trillion whatever market. Is that right, Joyce? 4 trillion, and we have like half, we have 500 billion of dedicated EM money, is that right? Like a little more. Joyce knows, I don't know. That's why I have to come wherever she tells me to go. So, you know, around there. But, you know, you have to get, the rest gets picked up by passive people. So ratings wind up mattering, right? So you get some credit for whatever reason, and it gets rated in a funky way for whatever reason. You wind up with a substantial structural anomaly that doesn't go away for really a long time. So you look at PEMX, right? So it was, you know, we have 3 rating agencies. They have 3 different ratings for the thing. And when everybody was IG before Mexico slid a little, then they would all be above IG. So you had sort of $100 billion of whatever issuance that happened. Now it's down to about 70 billion outstanding, whatever it is. And it was all fine. But then as Mexico became less creditworthy, PEMX also fell down a little bit, and the 3 rating agencies have 3 different ways of rating. So one of them says, well, it's just like the sovereign. The sovereign keeps telling us, like yesterday, Claudia Scheinbaum said, it's guaranteed. And, you know, 2 other rating agencies have different strategies. One takes it as a standalone credit and up notches it. One takes it and it down notches it. And, you know, one of them looks at support and has qualitative, you know, ideas of what support is. One of them, you know, is no longer has any access to the company because the previous president of Mexico fired the rating agency, and so they no longer speak. So they're rating without talking to the actual person they're rating, and it gets really messy because these qualitative measures get really messed up, and so you have things like should be very strong. So then all of a sudden you have like something that's guaranteed by the sovereign probably, that's what they said anyway, and it's trading, you know, 350 off, you know, the sovereign credit. And so, and every bond on its yield curve has its own discount rate. So those things I think are actionable and fun. They happen everywhere. They happen in corporate capital structures where Sometimes junior bonds are cheap to senior bonds. Sometimes senior bonds are cheap to junior bonds. They happen in every country, no matter how developed, no matter how complete the market is. As soon as you have inflation-linked bonds, they are not efficient to nominal bonds at some periods of time. Sometimes that period of time is a couple weeks. Sometimes it's decades. So this is just like we create instruments, but then they may not have as much demand as there is supply of those instruments, or it might be a pretty niche reason that somebody wanted it, like they wanted a metric of what people's inflation expectations were, but then they're really not getting it. So there's a lot of reasons, there's anomalies, and it's a pretty narrow thing, but it's kind of fun.
Great. And hopefully we'll come back to Mexico. Just maybe, as you're thinking about portfolio construction, how do you think about fixed income in the context of the traditional 60-40, portfolio?
Wow, I think that's the biggest question of the day, to be honest, because we really need to understand how do bonds fit in, right? So are they inversely correlated with equities? Can we rely on correlations? What happens when correlations flip? We need to be forward-looking, not backward-looking. Like, we just run regressions, and we say, oh, well, I want to have bonds in my portfolio because they'll do well when stocks don't do well. But the principal cause of stocks not doing well is like an inflation spike. That's not going to work. We can all understand that. And when we have earnings being discounted by a rate, if that rate goes up, maybe even locally, it won't work. So I think this stuff is really, it's important to think about. There's obviously all kinds of different bonds. There's real bonds that are cheap right now. And there's, all kinds of things to use. I do think that it's, in developed markets, I do think that these are really a store of, bonds are a store of value. And they are often easy enough and have less slippage and fewer mispricings than almost anything else. That doesn't mean that I haven't had a fabulous career where we've returned, taking advantage of anomalies in that space, but still, what the world is about, what's the best option, not what's the perfect option. So I do think that they're an important part of people's portfolios, but I think we're going to have 2 or 3 years where everybody needs to be an investor, not just an allocator. And they need to think about, what do real rates look like? What's going on? How does this fit in with my exact portfolio and with my liquidity perspective and with my potential liquidity needs? People need to go back to being investors and thinking about asset liability mixes of their own institutions and to think about what they're doing. And I think that's going to be really exciting because I think that's a really interesting puzzle. And I bet some first-order things are going to really determine what people think.
Okay, great. And I know you started touching on the developed markets. So, the last few years has been around U.S. exceptionalism, even though, the deficit remains an outstanding issue. So how are you seeing the risk in the government bonds, particularly related to higher for longer, and also thinking about the U.S. Treasury funding needs?
Well, I wish we're on a stage during the middle of our nation's refunding, so we don't even know how it's going. But I think, look, America educates a lot of people and gives them a chance. And as long as we keep doing that, and we have labor market mobility, if you take a long view, I think these choices are exceptional, and I hope that many more countries make them, and so that we don't even notice that that is the norm.
Okay. And then can you share your thoughts on your expectations for bank regulation reforms that support market function?
My views are very derivative of people I work with who know more than I, like Matt Rutherford and other people. I think it was a good moment to look at the plumbing, take it out. We have technology. I think it's a really exciting moment to kind of figure out how can this work, how should it work, can we do, and to democratize and make things more sensible. I think we've had a few steps in some directions that don't look to me like they're going to be that robust around kind of some centralization, which I think may turn out to be single points of failure. But you never know. I think we got to kind of really hear it out. And I don't think that there'll be that many people interested in this process. So maybe it will be more intelligent than usual.
Okay. Maybe just turning quickly to Europe, what's your outlook just for Europe, and how are you thinking about investment opportunities there?
Europe's really funny. We do find a lot of opportunities in Europe because there's a lot of inefficiencies various places, and Europe has some real barriers to capital efficiency. It doesn't look like it's going anywhere. And I think it would be really exciting if this was Europe's moment to shine. But I don't really see any real changes in what they're up to, so I don't know how that would happen.
Okay.
But boy, would that be great.
Do you think the Draghi proposal has any legs?
I hope it does.
Yeah, they need to. Okay, great. So maybe, we in the last 10 minutes, we can just turn our perspectives on the emerging markets. That's an asset class that has been, quite challenged given the ongoing wars, which are kind of transforming trade and investment flows. So it looks like they're going to be big winners and losers. Let's start with China, where there's a big stimulus program right now underway. How do you look at China's future prospects?
I think there'll be two more people who talk who are going to know a ton more about China than I'll ever know in my whole life. One of them, Joyce, but I think I think there's a lot to talk about in like standard Western Hemisphere EM that I think is more tractable and of the moment. Mm-hmm. But I think China's, it seems like they do a pretty good job of taking care of their own business. So I wouldn't count them out.
Okay, so then let's turn to Latin America. I think specifically, Argentina and Mexico. Maybe starting with Argentina, President Milei has, since last year, embarked on a dramatic reform agenda that includes fiscal austerity and institutional reform. Can he stay the course and maintain the political support? And of course, the big question, is this time different for Argentina?
Well, for sure this time is different because they've done something.
Yeah.
So already, like just in the rearview mirror, we can definitively say that this time is different because something actually happened. I think it's interesting when we think about Argentina as we sit at our own moment here to not link what goes on there to anything that goes on in a regular place. Javier Milei did understand that it couldn't go on and he had a North Star that saw his way out of the problems that existed. And I think that's leadership. That is what leadership is. So have they had a massive austerity program? Probably not, right? There was a lot of things that were going on that didn't actually serve anything but some minor stakeholders or maybe some major stakeholders in their economy. So you get a really different outcome when you stop doing things that only benefit a few people than, which he calls the caste, than if you engage in a traditional austerity program. So my hat's really off to him and to Federico Sturzenegger for really trying to take it apart and saying what are we doing? And one thing that they did is in some places, they have been pretty surgical. Maybe they were more constrained in the way that they stopped. Some places they've been less surgical. Go just shut down he afuera, like just shut down this agency, shut down that agency. But I think there's been places where they have shown a certain deftness and ability to understand what they were up against. So I think, and I think they're doing a pretty good job, which I don't know that you can really have a through line to many other places. I mean, no, I don't know many places that make the really ridiculously bad choices that Argentina's made since 2001. So, it was very much a cave. It wasn't a tunnel. They had to turn around to get out. So I think it's hard to read through to us, but I think it's pretty encouraging, and they have a lot of raw materials if they want to stay the course on being and like being willing to pay people and having order. I think they can do it, and I think they have a pretty simple philosophy and directive. So I think it's an encouraging. I think it's an encouraging story. Obviously, there'll be ups and downs. It's very hard to change any country, but I don't know. In a world where there aren't 1,000 bright spots, it's definitely one.
Yeah, that's great. And then I know you've been a long-term follower of Mexico. We've seen a downshift in investment flows since the recent elections, and especially given concerns raised around the judicial and constitutional reforms, as well as the potential renegotiation of the USMCA. So how are you seeing the prospects for Mexico?
I think Mexico is, on our southern border. This may be complicated for them. But so far, I think that everybody follows us as closely as everybody. And I don't want to say anything that's really not kind of marginal in the last 6 to 10 weeks. But I have to say, Claudia Sheinbaum looks like a leader. She has some vision. She has a lot of charisma. I can say the whole word because I'm over the age of 30. She seems to be taking things in stride and representing the people of Mexico. And that's what leadership looks like. So I wouldn't say Morena's that encouraging, and maybe Joyce has more to say about their idea of how you can make a country grow, but conditional on her being from Morena and the cards that she had to come in. I think she seems better than I would have guessed. I do think that they need to do something to sort out their budget stuff. I do think that this Pemex is a tractable problem with which a reasonable person could deal with. And I assume I would say that I think it's much more likely than I thought 10 weeks ago that sort of like you have somebody reasonable who's thoughtful who can do this. So that's pretty exciting. Also, I think it's kind of exciting to see it unfold. I think it is I think this USMCA stuff is going to be complicated and probably not going to make any pies bigger. And that's real, right? So I think you have to kind of put that in your model.
Great. Maybe in the last few minutes, I know you talked a lot about technology being an enabler. So how are have the recent advances in technology and innovation, particularly AI, reshaped your business operations?
Oh, that's a great question. Look, I think this stuff is great. I think it matters how you use it. Having a lot of computational ability is super exciting for a lot of reasons. We've had things we've wanted to do just in terms of risk analytics, computation, thinking about, what is the distribution implied by the option series of markets in a real-time way. So a lot of things that I think are more about the access to a lot of computational ability, even if the reason we're have better, cheaper, faster is because everybody wants AI, just the compute it's bringing with it, even with old chips and old methods, is pretty amazing. I do think AI is going to make all of our jobs better. I'm really hopeful that it will make people who are in the first 3 to 4 years of their careers jobs better. I know people who are at my shops, I hope, spend more of their day thinking about why is this happening and what should we pay for these than trying to get together our, comps. Like just if you think about responding to a bid list, it's just a totally different business than it was 5 years ago, which leave people with a lot more time to think about the securities, pricing, and where do you think these clear and are these interesting and how do they fit in? And I think that's going to be really great for people understanding what's exciting about markets and about portfolio construction much earlier in their cycle. And I think that will help like with stickiness in terms of people sticking with it and being really engaged in the puzzle and the intellectual adventure. I mean, I think that's what kept like you and me and Joyce. I mean, why have you've been doing this for a long time? What makes you excited when you come in every morning?
Yeah, I think this is one business that when I speak to even people starting their career, 25 years in, I'm always intellectually curious. It's so dynamic. There's always something different going on. So I feel like you have to do continuous learning. I mean, just even coming here and having a chance to speak to you, Nancy, like I had to, I read about Argentina and Mexico and a lot of different things just to kind of have a background. So I think it's just, I find it incredibly intellectually stimulating. There's always something to learn. And I think the FIASI has, we're going to be celebrating our 50 years this year, and we've created a forum to have, this community and, have these very, great conversations.
Well, that's like super exciting. Well, it's really great to be part of the conversation this afternoon and to see everybody here today and to get to know you a little bit, Monica. This is fun.
Thank you so much. Thank you for your astute insights and look forward to continuing our conversation. Thank you so much, everyone. Thank you.
This was fun, right?
Yeah, absolutely. Thank you.
Is what you wanted?
So thank you so much, Nancy and Monica, for that wonderful fireside chat and really tour around the world from market structure to talking about a lot of the top emerging markets as well. I'd like to welcome up our next session, which is going to focus on what lies ahead for the global economy and markets. And it's a real pleasure to welcome up Julia, Sarah, and Sophia, and Rebecca. And I'm going to tell you a little bit about each of them. So Julia is the president and founder of Macro Policy Perspectives, an independent research firm. She's also a professor of finance at the University of Texas at Austin and an alumni of the Federal Reserve Board of Governors, a member of its Economic Advisory Panel for the Federal Reserve Bank of New York. I'm so glad to introduce you to Sarah Devers, who is the global head of fixed income at Vanguard. So she has $2 trillion in assets, and her remit includes portfolio management, trading, and research. She's also a leader of their women's network, and I've participated in their conference. They do such a wonderful job of bringing their senior leadership in. She was previously a partner at Goldman Sachs, so another Goldman alumni. She also sits on the TBAC committee for Treasury. Sophia Drossos, who is economist and strategist at Point72 and an alumnus of the Federal Reserve Bank of New York, where she was chief dealer with oversight of open market operations. She also was an alumni of Morgan Stanley. But just somebody who has macro views I've respected for so many years. And wonderful to introduce you to Rebecca McCaughton, who is director of the cross-market monitoring and analysis team here at the New York Fed. And she oversees a group that's responsible for monitoring, analyzing all of the developments across global financial markets. She's also been at the IMF, US Treasury, and Morgan Stanley. So much to talk about. It's hard to believe that we're less than a month into this new administration. So what lies ahead for global markets and the economy?
Great. All right. Super. Thank you so much, Joyce, and happy to be here. Really exciting. I hope we continue this tradition. I always get a lot out of these discussions. So yes, no shortage of topics. So we're going to try to jam a lot in the next 45 minutes. I thought the way we would structure it is maybe first talk a little bit about the macro policy outlook, and then turn to implications for global fixed income and other markets, and then we'll wrap up with a really quick speed round on where you see markets going towards the end of the year. And we have about 45 minutes, and then we're going to reserve the last 15 minutes for questions from the audience. So get ready. So lot to unpack. I thought maybe, Julia, you could kick us off perhaps by just setting the stage on the macro backdrop, just given sort of what you've been observing, a straight read through from the incoming data. How is that affecting sort of your thinking about the outlook for growth, for inflation, for the labor market? And then we can open up the discussion more broadly.
That's a great way to start it, I think, just like where are we as we embark on this next adventure. So, the recovery from the pandemic, certainly the US has been the bright leader of the global economy. That's not the mirror image of last cycle when China was the leader of the expansion. The US sort of resumed leadership position. And there's a lot of things that drove that. Obviously, the policy impulse was huge. Both monetary and fiscal policy was huge. But, we were pretty bullish on the recovery. We never had a recession call because I think there was something deeper going on. And I kind of see the pandemic as having been a catalyst for change. In some of the things Nancy touched on, there's so much technology at our fingertips, and necessity is the mother of invention. So we met a moment where we had to figure out a lot of things really fast. And we invested, and business leaders changed their operations and invested in efficiency enhancements, and we learned how to do a lot of things. If you just think about the way the labor market functions now, versus pre-pandemic. It will never go back to that. We do so much virtual interviewing, and so you can reach out and cast a wide net and search for jobs or search for people in very efficient ways that took so much more time and money before the pandemic. And that's just one example. You can look at any industry, healthcare and finance and the service industry, and everything has changed in ways that make it more efficient. So we've been kind of bullish on the productivity story, and AI is just the latest, generative AI, because we've had multiple generations of AI that have been invested in and been bearing fruit, and generative AI is the next phase. So, it's created this very resilient economy, always outperforming people's expectations. Does that mean neutral rates are higher or not? Is a very intense question for the outlook, and hotly debated, and we'll find out a lot. And so there's this productivity theme that we've been big buyers of, and then we also had this immigration wave that delivered labor force growth that we haven't seen. So first it shut down. We saw this constriction in labor supply, and then this abundant labor supply, and that's the thing that's going to change most dramatically, most quickly. And so what does that mean for growth, for inflation, for different industries? And that's, I tend to think that in terms of markets, that's getting underplayed versus the tariffs and the trade wars. And so we, obviously that's important, huge driver of the outlook, but lots of unknowns, a lot more noise than action so far. But the labor market dynamics, I think, are going to change very quickly. And so I think right now, when we look out, we're starting from a very solid position, very stable position. Globally, macroeconomically, heading into something that could be much more volatile on multiple fronts.
So maybe just peeling back the layers a bit, that's a great starting point for us, but thinking about sort of where we currently are and where we're headed, We've had a lot of sort of mixed survey data on inflations. We've had some, mixed inflation data coming in. And at the same time, there are potential policies that are shifting that could impact the way that you're forecasting. I can't imagine a job that you have now that's just less forecasting, more nowcasting. But how are you thinking about how this is impacting your own assumptions about where inflation is headed, both in the near term and the longer term? And then I'll open it up to both of you.
Yeah, I mean, both of the sort of key policy fronts, trade policy and tariffs, and immigration policy, they can go either way on inflation. And there's going to be a dynamic, right? So on the one hand, tariffs will raise prices. Yes, they will. Yes, no, there won't be a full dollar offset. There will be an increase in consumer prices. We saw it last time. We'll see it again. But that can be demand destructive. So if in the Fed, we have these models and these macro models. If you put a tariff in a model, it goes like this and this. It goes, and prices go up, and then because demand is weakened, it goes down. So it's a price level change, not an inflationary impulse, unless it's accommodated by monetary or fiscal policy. So near term, obviously, we can run the numbers and do all that. Same with, but then next year or later this year, what will happen depends on what happens on the fiscal front. How does the Fed respond to that? The Fed will want to wait and see. Where we are now is, again, in many ways, a mirror image of where we were in 2018. Yeah. We're above target, not below target. So they're going to, they seem to be very much wait and see. Same with immigration. So you could say, well, if you're going to reduce labor supply, that's going to make labor markets tighter and more inflationary. But it can also be demand destructive. The big debate in the economics literature is whether immigration is a complement or a substitute for domestic labor, and by and large, it's a complement. So it's a potential growth shifter. Right. So we've had this labor supply that might, at a minimum, go to zero, maybe negative. And so, will that be inflationary because it tightens up certain labor markets, or will it actually be disinflationary because it slows growth and weakens the economy? Right. It could do both, and depends on the dynamics and the time frame that you have.
Right. Sarah?
I would say, just on policy, very similar views. On tariffs and immigration, we're thinking of them both as sort of stagflationary impulses, meaning they both can drag growth and they both can crank up inflation. And how that manifests in the market. When you think about, we had the Canadian, Mexico tariffs that were sort of a surprise. The market on that Monday, we saw curve flattener. That was because the market was interpreting that as because of inflation, the Fed won't be able to cut. That's the short end, kept the short end elevated. But over the long term, it was going to, destroy demand, and it's going to bring growth down. So we saw the curve flattening. And then the other thing that we're really watching closely in terms of policy is fiscal. It's core to our outlook that we're going to have strong growth, right, pro-growth, but it's very top of mind. How are you going to pay for that? How are we going to pay for the tax cuts? So we already have a very large deficit. So, in terms of how the market has been pricing that, we see bouts of volatility in the term premium and fears around that. So very similar views.
Sophia, how do your views differ or not?
So on the policy side, the way I talk about it is we're going to get the bad news up front, and if there is good news, we're not going to get it until later in the year. So point 72, we have macro managers, we have long-short managers, so I do see a really good cross-section of different types of thinkers. And what's been interesting to me is that investors were really excited about the change in the administration and obviously Congress flipping to Republican hands and thinking that this was going to usher in animal spirits and deregulation and the like. And one of the things I caution a lot of our internal investors about is that deregulation's a great micro story, but not necessarily a macro story. And so then I think a lot of these expectations kind of have been built up and maybe extrapolated forward. People are looking too much at 2018 and saying, hey, 2018 wasn't a bad thing. But what I like to point out to people is that after we had the tariffs in 2018, it wasn't long before manufacturing started to slow. I know you know this, because we've talked about this, and contract. And I think as I'm going through the FOMC transcripts now, I'm realizing that the FOMC was recognizing that in real time. And that was one of the reasons for the pivot. But as Julia was mentioning, the Fed had a lot more flexibility because inflation was below target, so the Fed could be a lot more preemptive. So I just think on the policy side, maybe there's too much extrapolation from 2018, not enough appreciation on the corporate side of how difficult it is for them to manage this environment. So it doesn't seem to me to be an environment where I would expect a lot of expansion in business CapEx or hiring. It's just very hard for corporate managers to plan, and we're definitely hearing that and seeing that in the corporate results. So to me, I think the uncertainty is a bit more concerning. And like Julia, I have been more optimistic on the US economy, really impressed at the lack of interest rate sensitivity, which I think was a key factor in contributing to the stronger growth in the US. But now we're coming to a point where I am more concerned that the uncertainty is going to be a bigger overhang. And that's just an environment where I don't think growth is going to surprise to the upside. And maybe analysts now kind of have adaptive expectations. We've seen growth surprise to the upside. We've seen equity markets surprise to the upside. Maybe this is the year where we see disappointment.
So I'm wondering, Julia, from I guess forecasting standpoint, to your point, it's not just the tariff increases themselves, but the uncertainty of the wait and see, will they or won't they, the escalation, de-escalation. How do you bake that into sort of your assumptions about, corporate spending, corporate investment?
Yeah, so we have a profile of moderating growth. So again, we're coming in the year strong, very solid, but we do expect caution on the part of firms, caution on the part of consumers. We've seen in the last couple of years, we've seen a bit of a rotation within the consumer. Again, during the pandemic, we gave lots of money to lower, moderate income. They were getting the biggest wage increases, and we saw very solid spending. They've been a lot more cautious, and we've seen more of a wealth effect kind of driving the top line. I also think, again, that consumer spending has been importantly boosted by immigration. More people, more clothes, more food, more housing, and that is going to not be a source of growth. Even if we're not like deporting millions of people, it's just closing off the inflow stops that source of growth. And so we have sort of a profile of a moderation. And some of that I think of as a potential growth moderation, less labor supply, less population growth, lower growth. But again, to Sophia's point, the markets are adaptive, and we've had this relentless string of resilience and sort of upside surprises from the US. And again, what if we start, even if it's just a potential growth story, what if we start seeing payrolls in the 50Ks to 75Ks instead of 175Ks? What if we see GDP growth with a 1 handle instead of a 3 handle? That could be fine from a macro standpoint, but are the markets properly priced for that is the question.
So maybe to that point, Sarah, we often do look to bond markets, inflation compensation markets, other rates markets for the signal. What are they telling us about the macro outlook? So what are they telling you?
Yeah. So we have a base case really of continued U.S. exceptionalism. We'll cool some, but we expect growth to continue to be strong, north of 2%, and inflation to remain sticky. So, in terms of the Fed, we see them as they cut 100 basis points as were largely insurance cuts, which seemed to be the right thing to do at the time. Now they're going to be data dependent, and the data has been strong, right? We've seen strong payrolls, we've seen strong inflation reports. The Fed themselves have said they're in no hurry to cut rates. So we think that's prudent, especially with all the policy uncertainty that's coming. So our view is that the Fed will not cut rates before middle of the year. We've penciled in 2 cuts for the back half of the year, but certainly possible there are 0 cuts. Related to that, people are always asking, well, why is the 10-year higher? Why is the 10-year 100 basis points higher when the Fed's cut 100 basis points? And that's sending us signals to your question. It's very unusual for the 10-year to move that much after the Fed is cut. I'm just looking at my notes here to see exactly how much. I think where we are, 90 basis points. Let's say we're higher from the first Fed cut. Why? A few reasons. First, I would say growth. When that first Fed cut happened, growth has been surprisingly upside. That first Fed cut, we had a lot of fears about the labor market. There were fears about the labor market, and the market was pricing on a forward basis that the Fed would cut all the way to 275 as a terminal rate. Okay? Since then, the labor market has stabilized, maybe strengthened, some would say, and now the Fed pricing is just cutting to just below 4%. Right? So Fed fund futures are higher. That means the 10-year has tracked higher. So that is growth. You look at the nominal move, more than half of it is in the real rate, and less than half of it is in the inflation rate. So while both have contributed, I would attribute most of it to being surprised about the resilience of growth in this US exceptionalism. The second reason we believe that the 10-year is unusually higher after the Fed has been cutting is because of uncertainty. And uncertainty manifests in the term premium. The term premium is a risk premium. The more uncertainty there is, the more you need to get paid to take that risk, right? And there's uncertainty about a lot of things. Uncertainty about growth. Where is our star? There's uncertainty about inflation. It's come down, but is it stuck? There's uncertainty about all the policy changes that are coming. And so that term premium has risen materially as well. So where we are looking forward, we actually think right here, the market's pretty fairly priced. Right? We think about 4.5% on the 10-year is fair. But we've been thinking a lot about asymmetries. When the Fed started cutting, there were 7 cuts priced for this year. Now there's, what, 1? One? So we think there's a lot of room for rates to retrace lower should there be any kind of stubbing of the toe on US exceptionalism or any kind of stubbing of the toe in the growth, and given where valuations are and they're so tight. And similarly with the term premium, that moved really quickly. And so if there's any kind of cooling off of these fears on fiscal, or that uncertainty is resolved and the worst case doesn't happen, that risk premium can come back down. You can effectively harvest that return by being long at the 10-year point. So it's definitely been a lot of cross currents in the market.
Great. We'll get to the stance of policy, and I want to hear your views on that as well. But before doing so, what do you make of sort of what you've observed in terms of the reaction in inflation swap markets, for instance, to some of the inflation data coming in? And does it seem sort of appropriate, consistent sort of with your expectations?
So I do think that, I believe very strongly in adaptive expectations, and I think there's an element of that as well. I mean, I take kind of to heart what Julia said. It's not clear to me how inflation is going to pan out versus the narrative, but there's certainly a narrative that fiscal is going to be expansionary this year. So I kind of take the other side of that, because I don't think we're going to have any resolution to fiscal until we're right up against the expiry of the 2017 tax cuts. And the news flow so far, very early, but has suggested to me that maybe these narrow majorities and the lack of fiscal space are going to matter. So I think that perhaps there's maybe too high of an expectation of how stimulatory fiscal is going to be this year. And then I'm still sorting through the Doge, which is so interesting. But again, it doesn't seem to me that this is going to be a very fiscally expansionary environment. And then I couple that with the tariffs. And I think a lot of people, a lot of the analysis I've read from outside of our institution, outside of the panel, focuses a lot on like the textbook, like one-for-one movements and the like. So again, like Julia, I see it more as a relative price adjustment. I am cautious because, again, I don't want to underplay this huge spike we had in inflation. There's a recency bias among consumers as well. And I think we saw that a little bit in last Friday's UMich survey. But I'm hoping that gets revised down, so I don't have to worry so much about it. But again, I think the inflation fears are out there, and I think what could end up happening is that people underappreciate the uncertainty. So for me, I am looking for growth to slow. I am not sure about how some of these immigration issues are going to pan out, but I do think that the growth dampening effects are probably underappreciated. And I also have a lot of faith in the credibility of the central bank to do the right thing and not, we're all data watching, but if the inflation turns out to be, starts to see a bit more momentum, if the labor market regains momentum, I do anticipate that the stance of the Fed is going to be commensurate with squashing future inflation.
Right.
Can I jump in and say, on the fiscal, one of the things that is sort of new development in the DOGE issues is, this element of uncertainty in sectors that never knew uncertainty, right? Like the turning off of contracts and the taking back of payments, and you see universities and state and local governments and research institutions kind of like, trying to understand what's happening, and that introduces, again, these are institutions that operate on this kind of very stable flow through of federal funding for a variety of programs that get matched with other funding, and there's like a whole infrastructure that, that's being intentionally disrupted, but then what are the spillover effects? Because some of these sectors, healthcare, state and local governments, they've been the pillars of job growth for the last couple of years. And sort of, demographically, they're like big pillars of job growth and stability in the economy. So how do they respond? I see from colleagues at universities, hiring freezes and freezes on, new projects, and, there's just that new element, whatever the dollars and cents of the fiscal end up being, there's a new layer of uncertainty in areas that are not used to that, and what is the ripple effect through the economy of that? That's been an unexpectedly dramatic development.
Right. No, it's a good point. And I should have mentioned that you each owe me a quarter every time you say uncertainty.
We could do vodka shots.
So on that point, on the spillovers, I'd be curious to get maybe Sarah and Sophia, your views on, like, just over the last 3 weeks or so, as sort of markets have had to sort of adapt. How are they thinking? What have you observed in terms of the ability to hedge hedge against potential uncertainty for a protracted period, possibly, or position for additional uncertainty? Or what are the opportunities that you've observed, at least, in terms of sort of a period that we're potentially in for a while now of elevated uncertainty?
Start with me. There is plenty of opportunity to buy insurance because volatility is a lot cheaper than I thought it would be. Whether it's currencies or equities, like sometimes I'll talk with the portfolio managers and I'll say, the president has a press conference at 1 o'clock and he's going to unveil this. He's like, equity market doesn't care, break even's like whatever, 30 bips. I'm like, okay. So I think one aspect is that the sequencing is hard, and I think that perhaps is a factor, right? You don't want to bid up option volatility if you don't know that the event risk is imminent. And I also think that there's a lot of moving parts. Like we've talked a lot about the U.S. One thing I've been very focused on is on the geopolitical side, what's going on. And I think the headlines on Ukraine are starting to come through a bit more meaningfully, a lot of circumstantial evidence of perhaps moving towards some type of resolution. Who knows exactly what form it will take, but then thinking through, well, what does that mean for the rest of the world? What does that mean for Europe? One place where we have seen outperformance this year has been in European equities. So I would say that one way I think that investors are dealing with the uncertainty is to perhaps reallocate. I feel like I have had more conversations like that internally. What are the places that are not priced to perfection? Maybe if you're allocating money, if you're a portfolio manager, you do want to look at some positions that can bring down your volatility. You want to avoid spaces that are crowded. We've already sort of had a bit of an accident in some of the highly positioned AI names earlier this year. But again, thinking through what some of these other policies could mean for other economies at a time when maybe the outlook for geopolitical conflict is going to move lower. What does that mean for energy prices and the countries that had the negative terms of trade shock from higher energy prices? Could they benefit from lower? And then the final thing I'll mention is, people have been very focused on the U.S. outperformance, but as you and I know, there's always cycles. And so you're always kind of looking for those turning points and the warning signs that you're getting to turning points. I've been looking at economies where the central banks have also been proactive in terms of policy easing and the like, and looking to see if we're starting to get some shifts. And places like Canada, you're definitely starting to see that there's a credit impulse that's happening, and maybe absent some of the tariff threats, you could probably envision a different path for the Bank of Canada there. So again, some of these other factors bringing up the potential for diversifying your holdings, and I think that's one way people are dealing with the uncertainty.
Sarah, what are the opportunities that you see or challenges related to the degree of uncertainty that markets are facing?
Look, I think when there's volatility, it gives you both risk but also opportunity. It's really a great environment, but careful what you wish for. Like, you don't want too much volatility or the wheels fall off and you can't get trades done. But in a reasonable amount of volatility, there's ability to really monetize that in active. When volatility is high, there's a dispersion in valuations, security selection, various systematic trades that we do. We're able to monetize that relative value. So I would look at it that way. The other thing that I really strongly believe in is, when you're constructing portfolios, you want to have ballast, right? So 60-40, whatever you want to call it, having some bonds in your portfolio as a stabilizer in times of stress and equity risk-off scenarios is something that we would advocate for right now.
I would just add one thing to that. One thing, I think people are holding cash as well. I mean, you can definitely see it in the money market fund. You can see it in the repo pool here. You see it everywhere. But there definitely seems to be a higher value to holding cash, and obviously that is one way of bringing down volatility.
Right. Okay. And just coming back to the stance of policy, then I think Sarah, you had mentioned you're expecting 2 more cuts for this year. Markets have continued to scale back pricing, where you mentioned one cut. Is policy restrictive at this point, or how are you thinking about the path of policy?
I think it's still restrictive, but deservedly so. I think the point was made earlier that when the Fed started easing, there was a sort of a different environment, right? We were getting some signs that things were slowing, particularly in the labor market. But obviously the underlying economy has been more resilient. So to me, seems like we are slightly restrictive. We're a bit in that wait and see mode. There's not as much visibility. All the uncertainties that we're talking about are uncertainties that central bankers also have to deal with as well.
Julia?
So I do think policy is restrictive, and I don't believe in the narrative that the economy is no longer interest rate sensitive. I think the way I kind of parse this out is that, you can look at any interest sensitive sector and it's clearly restrictive, but we've had these winds at our back. We've had these tailwinds that have lifted and offset that restriction, the productivity impulse, and the immigration impulse. And in a sense, that makes, dare I say, spot R-star. There's R-star and then there's spot R-star. The spot R-star is higher than long-term because of these tailwinds. And so what happens to those will sort of reveal the stance of policy. So on the productivity side, we've been reasonably optimistic. We remain pretty optimistic. Quantifying that is the hardest thing in the world. productivity growth? Is the impulse going to keep growing? Is it going to be bigger? Is it going to be smaller than it's been? You know, we've had a really nice run on productivity, and I do think the trend will be better this cycle than last cycle. You know, exactly how that unfolds this year is harder to really pin down. On immigration, that's where I feel like I know where that's going. I can look at the flows and the numbers and actually put some numbers on that. And so it has, that's going to bring spot R-star down. And what that means is it will reveal some of the restriction of current policy and we'll feel more of the slowing. That's our anticipation. So. Our thinking on the Fed is that because we're going to have this impulse from tariffs, however big that ends up being, depending on what actually goes through, if we do, which we do, that is our baseline, we'll have some impulse, near-term impulse on inflation from tariffs. That's going to make the Fed's job very difficult, and so the next cut will be motivated off of the labor market. That's kind of the way we think about it. It's not going to be motivated by progress on inflation. That was our prior forecast. Our prior forecast was that we were going to be pretty darn close to 2% by the end of this year. Underlying dynamics still look to us very, you know, like they're stabilizing, they're going in the right direction. There's a few echo effects from the pandemic inflation and service prices, but nothing very worrisome. Consumers are price sensitive. Like everything looks fantastic from an underlying standpoint. But you're going to have this kind of difficulty to read the tea leaves from the tariffs in the near term. And so, you know, you're not going to see that progress. It's going to get interrupted. And so therefore, what will motivate the next cut? You know, and then, you know, we're having conversations with our clients. Could they even hike? Sure. Like what if we're surprised to the upside of our forecast for slowing growth? And this productivity impulse is, you know, quite persistent and strong. Could the Fed contemplate a hike? I mean, it's certainly not our base case, but we are having those conversations more. And there's such a range of views in the market right now. And I think, like Sophia kind of touched on it, there was this euphoria, you know, after the election, and there was kind of an assumption. One, there was the bias of, look at 2018, everything was fine. And then like, why would he do things that are bad for growth because he knows they would be bad for growth? Sort of the deductive reasoning. Why would he do anything that's bad for growth? And now it's like, oh, there's going to be some things that might be bad for growth. So there's like a broadening of views now, I think. And so, you know, some people still very optimistic, some people more pessimistic, and so that makes for good trading, but also volatility and dangerous trading as well.
Right. Could I add something on the restrictiveness? Just like a slightly different angle on is policy restrictive? Totally agree on R-star, like where is R-star, spot R-star, long-term, short-term?
Right.
We think it's higher, the Fed thinks it's close to 3, we think 3.5 to 4. But I feel like we've been so hyper-focused for so long on the policy rate and is it restrictive, when perhaps we should be thinking about where's the 10-year. Right, maybe, people refinance their mortgages and they locked in really low rates, and corporations locked in their funding, and everybody's in really good shape and good balance sheets, right? But that 10-year, the curve bear steepens, which is what we've seen in that term premium going higher. Mortgage rates are even higher, and the financial conditions aspect, not where the Fed policy rate is, which we seem to not really be that sensitive to anymore, but where the 10-year note. And I feel like that is what you're hearing more out of policymakers, questions about, wait a minute, I thought when the Fed cut rates, the rates were going lower. So I just wanted to highlight that, as it feels like the conversation can be shifting away from just what the Fed is doing and more towards where 10-year treasuries are, as in terms of restrictiveness and financial conditions impact on the market and the economy.
maybe talking a little bit more broadly about financial conditions, because certainly the chair got a number of questions about this the last couple of days, the level of rates. What about sort of, the dollar has certainly been driven by interest rate expectations, interest rate differentials. I'm curious to see what your thoughts are going forward. What is your outlook for the dollar, just given sort of the underlying backdrop that we've been discussing?
So the starting point for the dollar is very high. So I, as a good former Fed staffer, I love to look at it on an effective exchange rate, real effective exchange rate basis. And if you do, it's eye-popping, right? Where the dollar is kind of back to the levels that we saw in the aftermath of the Plaza Accord. So that's telling me that there were a tremendous amount of capital flows coming into the U.S. Really as a key investment theme post the pandemic was AI, tech-oriented. That was also very reliant on financial conditions, right? We had the stance of policy was very accommodative in terms of the monetary policy stance and obviously in terms of the financial markets as well. So, again, so many reasons for investors who wanted growth and wanted differentiated growth to prefer the U.S. And that trade has worked very, very well. We're just at extended levels where you need to ask yourself, especially if you're a foreign investor, all these economies with current account surpluses, they just need to ask themselves, like, at what price am I funding the U.S. current account deficit? And again, I think we're quite extended. One thing that I kind of worry about in terms of valuations on the AI and the tech side, we are in uncharted territory. I mean, like, I look at some I was like, what does a 46 PE mean? I just don't even know what it means, right? So it can just take any small bad news. I mean, and it doesn't even have to be bad news.
Right.
It could be sort of, as Julia said, like, I don't think the U.S. economy is going to fall into recession, but I think the growth pace slows. And I also think, too, one question I get from some of our internal investors is, what's the discount? What discount rate should I assume? What corporate tax rate should I assume? And again, if you aren't getting proactive Fed easing and perhaps we don't see corporate tax cuts manifest in the way that maybe some people expect, that we could see a bit of an unwind there. So I definitely would not be chasing the dollar higher at this point, and I would also sort of keep in mind other things on the radar screen. What if there is positive resolution in Europe? I was just pointing out to somebody the other day, this person didn't believe me, the unemployment rate in Europe is near historic lows. Consumer savings are very historically high. They never spent their money, although they didn't quite get the stimmy that we did here in the US. But the raw material for expansion is there. The ECB is cutting rates. And now, what if I tell you that some of the most energy intensive companies in the world are going to see their energy costs fall? What does that say? And again, I'm also very watching of what happens across different sectors in different countries. And seeing Eurostoxx 600 at historic high, I think is very meaningful because we do have a lot of investors that are incredibly rational. They're not just following momentum. Most people are rational. So they're looking for what is cheap, where could there be some event risk catalysts that could kind of help catalyze the value. And so for me, it's probably the case where maybe expectations and the optimism of the dollar are overdone. It doesn't have to crash. But it seems to me if the dollar comes off, that also helps some of the concerns the administration has about competitiveness as well.
Great. I know we're running close to time, so, and we do have a couple of minutes that we've set up, 15 minutes or so, I think, for questions. But before doing so, I thought we could do a quick speed round on each of your thoughts in terms of the direction of different asset classes. And I think I know the answer to you for the dollar, but we'll ask anyway. So just a higher or lower, no number. So I guess for 10-year Treasury yields, we're at 4.5. So by the end of the year, where are we going to be, higher or lower, Sophia?
Lower.
Right here, clip your coupon.
Lower, a little bit.
Okay, great. S&P.
Lower.
Lower.
Lower. Which means it's going to be high.
It doesn't have to be a lot lower. It doesn't have to be a lot lower.
Great. And well, the dollar.
Lower.
Stronger or weaker?
Stronger.
Okay.
Lower.
Great. Well, it sounds like some convergence, a little bit of divergence. Next time we should make sure to pull the audience so we get a little bit of a bigger sample. So with that, let's open it up for questions. I think we're going to do those digitally. And Fina, you're going to help me out here with questions. And I know this is not a shy audience, so.
Okay, so the audience can submit questions through the app. And so we'll start off. We've discussed a lot of potential uncertainties today. What are some key certainties that you anchor to as you navigate this upcoming year?
Certainties. What?
Where do you have a lot of conviction?
We're macroeconomists. We have no certainties. I will say, though, actually, one thing that has completely changed in the macro landscape that I don't think we talk about enough is oil prices. Oil prices are not the macro transmitter they used to be. The last impulse we got was around the Russia invasion of Ukraine, and then it faded pretty fast, and we've had insane amounts of global volatility. And pretty range-bound. And that's a disruption, and reflecting the U.S. supply landscape, which is only going to be less restricted going forward. So we tend to think of the oil price as the thing that that transmits global risk, that influences currency movements. That dynamic has completely changed. And that actually bodes well for inflation stability and global stability in a way that's kind of feels odd in this environment of geopolitical instability. But it's something that I'm trying to think about and understand better.
Right.
It's not a certainty.
Yeah, my one certainty would be that there's opportunity. Back to my point on volatility creates risk and opportunity. So I think there's going to be a lot of opportunity to generate alpha this year.
My only certainty is because I follow all the policy developments at Point 72 that I'm going to be the most popular person at Point 72. I have been for a while for my winning personality. Just kidding. But I can just tell with the incoming. So, but I think it matters a lot particularly for equity markets. When I have the tech guys or the biotech guys calling me, I know something is up.
Yeah.
Any others?
Yes, thank you. Other than tariffs, what are other components that you think could keep inflation elevated this year?
So there is a possibility that there is some tightening in the labor market from the immigration policy. So in most areas where we've looked at the data and the research, things like construction, for example, actually I don't expect inflation to come from that. Well, longer term. We do have an episode of deportation policy under the Obama administration, and there's a number of research papers that have looked at what was the ramification, and you can really identify it because it was implemented on a county-by-county basis, so there's lots of good data. And the findings are pretty robust that because labor is complementary, not substitutes, the whole sector just slows down. So it's not like the labor market's going to tighten up in construction and we're going to get wage growth. No, it's just that you're just going to see less building. And that less building will mean less supply, and that's already a problem. So over time, we expect near-term rental disinflation for the rest of this year. But then beyond that, we could see it turn higher because we're going to lack supply.
Yeah. Do you think that's priced in? Longer term pickup in inflation as a result of restricted immigration?
I don't think so. And actually, we have a forecast for a falling unemployment rate, which makes me a little uncomfortable, but that's how you know it's a good forecast. So I don't think so. But it is interesting. If you've been in this business for a while, you've seen a lot of different cycles, but not everyone has seen a lot of different cycles. And so for me, one of the super big picture lessons is we have a lot of people who have only been investing post-GFC, and they think that sort of global deleveraging episode was somehow indicative of the future. And I always say to them, no, we're going back to the way things used to be. Like, it's so great, you know. Real yields, 2%, that's not high, you know.
Yeah.
Term premiums, they're actually not high relative to history. So I think we could get some mean reversion in a lot of trends.
Yeah, I would say that the tariffs and the immigration it's a tug of war. There's both stagflationary impulses. The market's a tug of war between the stag and the inflation. So we see it being difficult for the inflation really to persist from those things. So I do agree in the short term it can, but the growth will catch up and bring it down. Where I do see the inflationary impulses on the fiscal side, and certainly if inflation expectations run away, and you can get a spiral from that.
And just real quick, I mean, I do think, you know, I mentioned housing, but that's a relative price, right? As long as we have the Fed sort of institutionally independent and doing its job, inflation shouldn't reaccelerate. We'll just have higher rates.
Right. Yeah. Okay.
Thank you. Private credit and BDCs have been popular in the last few years. Do you see any hidden risks or challenges there?
We are going to have a panel on private credit. Any preview of your thoughts on private credit?
No strong views.
I think whenever there's an asset class that's grown that quickly, you take a look at it, it's grown like 3 times the rate of the public markets. There's reasons for that. One was we were at the zero lower bound for a while, and everybody, to find any kind of return anywhere, you had to explore other things, and also you know, bank regulation post-GFC, the banks stopped lending and other people stepped in. So there's a reason it grew. You could take the other side now and say, well, look, public market rates are high again, so people don't need to reach for yield, right? Why would you bother going into private credit? But I think it's here. I do think it's here to stay. You know, there are diversification benefits. There's all sorts of good things about it. You can pick up yield versus the public, not as much as you used to. You used to pick up 500, 600 basis points, maybe it's 200 to 300 now. But you still can pick up yield. But it is a liquid, you have to size it right in your portfolio, and you know, if that liquidity premium erodes, you know, there's less of a return. So I think it's also a little untested with rates here. I mean, most of these are floaters, right? And so it's yet to be seen how these companies weather these higher debt servicing. But generally, I do think it's an attractive asset class if you size it right for the liquidity premium.
And lastly, what are your expectations on deregulation and the market impact?
Deregulation.
Yeah.
Love it. So obviously we are already seeing some of it, right? We're seeing it certainly on the financial side, energy. So my kind of pushback when I see some analysis that kind of talks about deregulation adding to growth is I don't think financial market innovation was suppressing growth. I mean, I think that, you know, maybe there wasn't demand to borrow from banks, but they could easily borrow from public markets, which is what we saw. I mean, credit spreads.
Or private markets.
Exactly, right? We've seen spreads narrowing in
Nobody's
both private and public and private markets. So I don't think that was a big driver. And on the energy side as well, you know, I don't think, particularly for the U.S. now, I just don't think that the break-even rate on production has changed all that much. And I think that that's more important than whether there's deregulation on the sidelines. Now, certainly it can be important for specific industries and thinking about relative outperformance of certain companies, but I don't see it as a big driver of growth in the United States.
What do you think of the move we've seen in interest rate swap spreads? Does that seem to be reacting sort of in a way that you think is consistent with sort of expectations around financial deregulation, or?
You know, I just think that people are really excited and again, extrapolating. And so, I mean, I don't really have a strong view, but again, I would just think that the deregulation, again, can be helpful. But again, we need to see actually the extent of it. We need to see, I mean, what's going to happen with Basel III? What's going to happen with capital requirements? What's going to happen with the SLR? I mean, there's just so many things that are sort of coming. But again, banks in particular are probably going to have an opportunity to deploy their capital to more productive areas. But what's the what's the amount? How much of a difference is it going to make? And then again, this is a micro story. I think the macro story is a bigger driver. In every economy I follow, the banks are always a derivative of whatever the central bank is doing and whatever is perceived country risk premium.
I'd call out two things in fixed income related deregulation. The first is just banks and financials. We're overweight banks and financials. They're at the front end of the corporate credit curve, which we think is cheap. Fundamentally, they're strong. After SVB, all that fallout, they've really shored up their balance sheets and look attractive here. And we also think there will be some upside from the deregulation in the financials. And then the second aspect is SLR. I think, I was literally sitting in this chair last October at the Treasury conference when we were talking about liquidity in the Treasury market, and one thing that we discussed was SLR and other bank regulations, which have made banks less flexible with their balance sheet, which may be causing a decrease in sponsorship and intermediation in the Treasury market. So I would look forward to anything that would bolster the liquidity and resilience of the market, and deregulation is certainly a candidate.
Yeah, I guess I'd only add that, clearly banking is the most obvious story for deregulation. For that, when I press people who are citing regulation as a big macro tailwind, okay, what is the channel? For it to be a macro story, that bank deregulation has to convert into a big credit impulse. And again, I don't see in the corporate sector that corporations are constrained. I've seen a really strong investment cycle. There's lots of non-bank lending going on in public and private markets. Consumers are, depends on the price. Are they constrained? Do we start going down the credit spectrum and consumers start, taking on more debt? That was a story that I put more weight on when we thought long rates were going to come down. And I did sort of think, okay, you've got a lot of home equity. If long rates come down, you might, and banks start relaxing standards and leaning into that a little bit more, you could see a credit impulse there. So, but then that really depends on rates coming down and that being an attractive price for consumers. And so I've sort of taken a little bit out of that story based on where we've been in the last few months on long rates.
Well, I think we're going to have to leave it there, but please join me in thanking our panelists for a lot of food for thought.
Thank you.
Well, good afternoon, everyone. If I can invite you to take a seat. Good afternoon. If I could invite everybody to take a seat. I hope this is working. No, but we have a great session ahead of us, and I think in the last panel we talked about how the pandemic was a catalyst for change, and I think for many of us it was a huge catalyst for change on how we worked. There's, I'm at a firm where it's very famously 5 days in the office, but, there's work from home. But it was a big change in parental leave policies that went from, at least at JP Morgan, from maternity leave to parental leave, putting policies in place for fertility. So I felt like, you had that the pandemic was a catalyst for change in so many ways, not just for the markets, but also for the way in which we look at career development, balancing work-life issues. So it's wonderful to have this chance on this panel to talk about driving retention through all levels, and what the current state is and the look ahead. And I want to introduce our panelists and apologize that Erica Cermeta is not with us because she tested positive for COVID. She was so sorry to miss it, but she has said, I'd love to be back for one of these events. And I hope many of you will stay involved with this event because we'd love to have more of you engaged as we put together the agenda and the schedule and the programming. And I also wanted to say, please do stay for the cocktail. And I have been told that there's a whole banner up, like right before the discount window where you can take pictures. It is like in the discount window. It's very cool to have the reception here. So huge thank you to everybody at the New York Fed for hosting us here. But I'm really pleased to introduce Allison Manilis, who I've known since her time at JP Morgan. She leads the market strategy effort for Citadel, Fixed Income and Macro. And I've known her since she was at JP Morgan, where she was in charge of the North America asset managers' rate sales, all the US rate sales. Lupin Raman is also somebody who I have grown up with because much like Lupin, we're both sovereign debt specialists by training. She's a sovereign debt expert, has just left PIMCO's fixed income portfolio management group where she worked on emerging markets and ESG issues. I have to give her a shout out because she has a book coming out on how to invest in sovereign debt, but also has background in the IMF and World Bank. And I think just a great point to talk about transitions. Wonderful to have Amanda Weinberg, who is the Chief Product Owner for the Markets Group here. And when I read her remit, I was like, oh my goodness. Her remit includes implementing SOFRA, a topic near and dear to many of us. She had the pandemic crisis facilities, the standing repo facilities, and she has the market source resource search portal, so that's an awful lot. So I'm gonna turn the floor over to Amanda for this discussion on managing through, managing your career through all different levels and changes and transitions. And remember that you can submit questions through the app, which will come online as you're listening to the conversation.
Thank you so much. So I'm really excited to be here today to talk about how we navigate through career journeys, how we work our way through life itself. And we've got some very interesting conversations with two folks over here that have had really compelling careers to this point and are continuing to do so, as well as living very big lives. So this is a bit of we were joking, this is a bit of the human interest side of things. So we'll be a little bit less structured perhaps. But let's start by discussing some of the experiences you guys have had navigating transitions in your personal life as well as professional. So I'm going to start with you, Lupin. So you've actually been in a couple different kind of career spaces. You've moved geographically from California, London, New York. You've moved from the IMF to PIMCO, which must have been very different moving from one to the other. So can you tell us a little bit about how you navigated those different cultural environments?
Well, first of all, thank you very much for having me. It's great to be here. And you're right, when I was thinking about this panel, I realized and recognized that I actually have had many transitions. My first transition was actually moving from academia, where I was teaching at the London School of Economics, to public policy and working at the IMF. And that was really motivated by wanting to have a bit more of an impact beyond, pushing the frontiers of economic knowledge forward. But then while I was at the IMF, I worked on many countries, developed and developing, but I soon realized that there was a very large gap in my knowledge, and that was financial markets knowledge, both from a practitioner's perspective, but also from a theoretical perspective. And that motivated my shift to working at PIMCO and the private markets. At the time, I remember, and this was many decades ago, I'm aging myself, but at the time it was incredibly scary. Here I was, a fund economist. It was considered at that time a job for life. It was very stable, very certain. I worked with other PhD economists who spoke the same language that I did. And I was moving into the private sector, the cutthroat private sector, where there was a lot of uncertainty. And I think Sarah said that with uncertainty comes opportunity, and that was my mindset. So I knew the why of why I wanted to move, and so that helped me get over some of the fears of transitioning. But I remember at the time, many colleagues deterred me from doing it, and my mom especially was horrified, because in that generation, having a job for life was the golden ticket. You don't exchange that, even if you have huge upside in the private sector, for a much more uncertain, unstable career. So I think that, underpinning that why really helped. And you also mentioned geographical transitions. I did move from Newport Beach, California, where PIMCO is headquartered, to London, and then to New York. And that was motivated a lot by what I kind of think of filling in the gaps. So whenever I approach both my personal and professional goals, I have this framework where I look to fill in the gaps. And for me, when I looked at our business and just where the trends in emerging market and sovereign credit was at the time, I could see the gaps being in Europe and London in particular. So that motivated my move to London. And similarly, on the transition way back to the US, I felt, especially after Brexit, that really the focal point of financial markets was going to move back to the US. And that motivated the transition back. So underpinning the geographical transitions, I think, was this idea from my perspective that there was a business need for it. And it happened to also align with my personal goals. So this idea of just really looking for that business gap and looking to fulfill it helped motivate me in the transition.
So you took some pretty big steps from moving from public sector, as you said, rolled for life, into, straight into the pretty aggressive private sector. And now you're taking another step out of the private sector and really investing in yourself. Mm-hmm. Can you tell us a little bit about that latest transition and what's really gotten behind you on that?
I think it's exactly as you said. I recognized that the other gap in my life was myself. So devoting some time to my own personal goals and filling my own cup for a while, was the right decision for me. And in a sense, although it's very scary, and again, it seems very out of the norm, what helps me is that I have this background of transitioning. So I know what it's like to change sectors and to really shift my mindset and reinvent myself from a career perspective. The other thing I will say is, I have a very strong support system, and I'm very lucky from that perspective. So personally, I have a very strong family network. Professionally, I have a very strong network, and financially, I was able to make those decisions. Which for me, I think the biggest takeaway, if I focus on the last 2 points, is your financial network and your professional contacts are really important to develop. And I would say it's never too early to actually start developing that network. So I was really able to leverage that throughout my career. And if there's one takeaway for me as I transition, is really continue to build your network. So many of my mentees and colleagues that I meet in the industry, and actually even outside of the financial industry, in the professional services in general, they don't have the time to do that. But I do think it's important to realize that your job is not the same as investing in your career. And networking doesn't have to be a huge time sink. The mindset that I approached it with was really to think about how I can help others. And I've learned a lot from Joyce in that respect, where, you don't have to have hours of meetings or many evenings out. You can just connect two colleagues that have the same interest. You can invite colleagues to conferences and events. You can tell someone about a new job opportunity. All of that builds your network and waters that network, and you can leverage that when you need to.
I love that. So I'm going to turn to you as well, because you've made some pretty bold career choices yourself, particularly at a time in your life when you were building a young family. So can you talk a little bit about how that decision-making process went and what your experience was moving from JP Morgan to Citadel?
Sure. I definitely have a lot to learn from you on transitions, because the beginning of my career was actually marked with no transitions whatsoever. So I started at JP Morgan, and that's how I'm here today. Of course, we all know Joyce. But I started at JP Morgan from my internship there, and I actually made it all the way up the ranks in sales, in rate sales, to then running a team of asset manager salespeople that was regional, all the way up to MD for 14 years. So actually in that process, I didn't make a whole lot of transitional career choice. In that case, it was really growing with the corporation, growing with the different business needs, understanding how I needed to develop my career skill set to then approach the next level of each job, which is in of itself hard, less risky than moving to Cali and all of that. But it is difficult, and it requires you to learn new skills and retool at every single structured level. But I think the reason that Joyce thought of me for this panel and is really that my last move was certainly the biggest and the riskiest that I've taken in my career. And I think it's definitely one where like I just took that risk and I would hope to take more. So I just want to take you through that thought process. So again, I was running a sales team of sort of between 10 and 15 people regionally at JP Morgan, and I was going through the process of becoming MD. And during that time, it's actually really interesting. I find lots of women talk about this, but when your internal value rises in an institution and you start getting recognized for that, simultaneously, I have no idea why, but this happens, externally your value also starts to rise. And while I was going through the process of becoming an MD, I got a call from Citadel Fixed Income and Macro. For those of you who don't know, it's the hedge fund side of Citadel, so it has nothing to do with the security side. And they called me and said, look, we actually don't really have a job per se, but we have a series of problems. And we're interested in somebody who can think creatively about solving this series of problems. And that was like actually how they pitched the job, which is like relatively risky, right? There's no team, there's no nothing, there's no structure, there's no corporate. It's basically the exact opposite of what I had experienced to that point. And so when I sat down and thought about when should I make that decision or how should I make the decision, the way that I had always approached other career offers, which I'm sure all of you have faced in your career many times, I'd been asked to do other jobs in either other job functions or other asset classes. And none of them sort of hit this criteria of like how I think about my career success. This may be useful to you, and if it's not, you can think about your own set of dials. But I think about it as like a dashboard of dials. And for me, when I think about my career and just success as a human, I think about taking a job that's going to turn up the dial to these sort of 4 components as much as I possibly can. The first is intellectual curiosity, which I think everybody, if you're in this room, like you all really desire that. The second is impact. So what is the reach that I'm having? Either with my content, the way that it's perceived in the market, the reach I have, the impact I have on people around me, right? Impact can mean a lot of different things. Money, it's important. And lifestyle. And this was the first time that I had received a job offer where I felt like I had the opportunity to really turn up probably 3 out of the 4 of those dials in a meaningful way. And that's really why I made the jump. And in terms of transitions, when I think about what that meant, it was moving from sell side to buy side. It was also moving from being a manager in a corporate structure to then transitioning back to being an individual contributor, right? My worth was going to be the value of the actual content that I put out every day by myself on markets. And so that was also really appealing to me, was to get back to my roots, back to markets as much as I possibly could. And then to your point, I had my second child in the pandemic. And so I was doing this with like a 1-year-old, or making this choice with a 1-year-old. So it was, and 2 children. And it was really important to me. I have a wonderful nanny. I have a wonderful partner. I had to have them on board, which honestly, that pitch took longer. It took longer to pitch them than it did myself. Like, absolutely no question. It was a really hard pitch. And then I went through the like unbelievable task of basically taking every single task in my life, mapping it out, and automating much of it as humanly possible before I decided to take this job. Because you take a new job, the first year's tough. Doesn't really matter where. I mean, particularly at a hedge fund, but really anywhere it's tough. And so those are all the factors that went into my decision.
I think they're both very, very bold moves. And one thing that I'm reflecting on as I listen to you is both of you guys were willing to make changes within the industry and within the area of space, which makes you sticky to the industry to a certain extent. But there seems to be an element of personal risk-taking and personal bravery that's got to be present. And I think it's probably there for many, many of the people in the room. I mean, by the nature of the job is to take risks. But are you willing to make the same risk in yourself? I think you should. I mean, not to preach, but preach. So as you think about the roles that you've been in or that maybe you're currently in leadership positions, whether directly or indirectly, how do you translate your experiences into the advising and the coaching and the next generation?
I can start. There's so many things to consider, but I think there are a couple of things that stand out to me. I think the first, and this is really important, is not to work against gravity. I think if you, as an individual, are working with a management team or a boss where they don't have your back, or they don't value you, or you don't see that growth potential, I think it's really important to pivot and find yourself in a situation where you are going to be bolstered. So, a lot of the times I hear from colleagues that, they don't want to leave their job in spite of a more toxic environment because it's such a great job and they'll never be able to, have a similar type of job anywhere else. That's just not true. So really important to not work against gravity. Find a team where you're going to be supported. Find a senior management that is going to support you. I think that's extremely critical. I think the second thing is to continue always learning. It's really important to actually learn the skills for the next level up before you actually have that job. And it's something that Alison, you kind of touched upon. But I think that is also critical because our jobs in and of itself, especially in financial sector, it's so intense that you are just kind of almost keeping up just with your day-to-day job, let alone trying to figure out how you're going to get to the next stage. But really investing in yourself and having a boss that is willing to invest in you as well and help you map out that career path is also very, very critical. And I think the third aspect is build your network. I cannot say that enough, both internally within the company, but also externally as well.
I think that's sound. What about you? What would you say, Alison?
So I guess there's a couple ways, I guess, to approach the question, right? It's about the things that you should be looking for in your transition in your team. There's also where you see your forward. You should just be managing to the best of your ability to the job forward or the second job forward. That's much easier in a corporate structure. For me, I felt like I needed to step outside of that to maybe then go back, who knows? But I felt like I needed to make a sidestep in order to do that. I completely agree with you on having a team that's supportive, that's inclusive, and that takes risks on you outward. So you need people who are citing you, who are going to reference you, who are going to give you credit for where it is due. I mean, that does not happen everywhere. It is not a given. And finding a group of people where that type of interaction is prioritized and is valued, I think is really critical, because again, it doesn't happen everywhere.
I think that that's a really good segue into the next topic, which is actually thinking about investing in continuous growth and finding opportunities to be able to do that. So more from a content perspective. So I'm actually going to start with you, Alison, which is that you shared that in your current role of understanding market intelligence, there's a lot more work hands-on that you guys are getting involved in around machine learning and AI strategies. Can you talk a little bit about how you enter into this new space with technology or data innovation and how you bring that into your job?
Yeah, so I think a lot of people in the room know me, but even if you don't, you probably can, this will resonate with you, but like if you told me that I was gonna be the human in loop on a bunch of AI projects, I would have laughed at you when I took this job, right? Like that was not what I was anticipating this was going to be. I took the job 2 months before GPT arrived in November. I knew technology would be a critical component of market intelligence. You guys are all familiar with market intelligence in your own institutions, and actually on the sell side. But in the buy side, it's kind of a relatively new space to have a like-for-like team that does that. And so when I said that they came to me with a problem, like they actually didn't have an idea of what this thing would look like. So it was a lot of trial and error with human effort and with technological effort. The AI part of it, this is not unique to Citadel in any respect, but machine learning techniques have been around for a long time, and a lot of the way that people talk about AI, it's really just a piece of the toolkit that's actually not that dissimilar from things that already exist. For market intelligence, or the reason that I think it's interesting for my job function and for macro, is that it's been much more well-worn in equity space. And the reason is that it's a tickerized space. It's really easy. You get a headline, it is there's a single stock that you know that it's going to impact. In macro, you're talking about an amorphous set of narratives, an amorphous set of economic factors, and then you're mapping it to an entire, industry of fixed income products, which is all what we love and why we're here. But, there's 7 ways to trade front-end swap spreads, right? And so, I mean, I can think of 7 now, but there's probably more. I'm sure a lot of you have come up with more innovative ways. But the reality is you're taking a bunch of qualitative information and you're trying to map it into these macro assets, and you're trying to understand what is in the expectation of all these macro assets. And it's quite challenging to do that just on a human scale. And so we are, exploring new ways of how to do that. But I would echo the other panelists on AI, which is just to say, it's a tool in the toolkit. You have to understand how to use it. For me to say that I understand what it's going to do to the, the business in 5 years, I think would be, I'm humble enough to say that I can't tell you that. But what I will tell you is that I think it just brings up the average performance. I think it brings kind of the bottom to the middle in terms of performance of market intelligence. But I don't think nothing that I've seen replaces anywhere close to human expertise. And I think we're actually going to crave experts in particular fields in a really deep way, even more than we will before the advent of this technology.
Do you actually see a path where what you're discovering in AI and machine learning changes the way that you do direct recruiting or the way that you develop staff internally?
I wouldn't say that there's anything that I've done on the recruitment side for AI, no.
All right. So Lupin, you've also, I'm going to switch over to your experience as well, thinking about I don't want to say emerging markets with a capital E, but markets that are going to be changing or getting more or less dynamic. You've specifically talked about in your book, I'm going to get the name completely right, that is coming out on sovereign debt, how to invest in sovereign debt, have introduced some pretty interesting concepts that you've stayed very close to policymakers as well as in the private space. Can you talk a little bit about how you are using innovative thinking in marketplaces in order to set your own direction?
So I think that, a couple of things that really stand out, and just drawing also from Alison's comments, I think it's really important to be abreast of new technologies that are coming about because they are progressing incredibly fast. So most companies that have enough scale are doing in-house modeling and replication. If you're not in one of those big places, even if you're in a small to mid-sized place, I think it's important to actually hone up the skills to be up to date, because we are going to become incredibly out of date very, very quickly, and then it becomes that much harder to incrementally increase your knowledge base. So given that, I think just that aside, I think in terms of how I've thought about working on areas where I've seen missing markets or missing knowledge information is really to continually keep my kind of radar on several things at the same time. Throughout my career, I've always thought forward in terms of where the businesses could be growing the most or what thematic tilts could become important. And my work on ESG was actually one of those burners. I have to say, it's the story of working in sustainable investing and ESG investing is almost like the sayings of, overnight success is taking 10 years or longer. When I first became interested, it was a topic that I worked on, frequently, but low effort. I had several different projects that were continuing in the back burner, which had potential upside, but I was also very wary that, there could be significant downside if certain things didn't pan out. With ESG and sustainable investing, it was very clear to me from the beginning that there were huge gaps between what companies were providing, especially buy-side asset managers, to what our clients were asking for. And the initial ask was really this gap in analytical frameworks and how that can be integrated in investment decision making and risk management. And so just coming from the kind of background that I had, it was relatively straightforward for me to think about frameworks about how to mitigate those risks. So using ESG factors as risk mitigants. So that was one area that I was able to kind of really invest with really low effort from my perspective, and also essentially put out the feelers within the organization and within our business side to see whether there was actual interest for launching an ESG fund or developing this strategy much more widely. So really my takeaway from that is, this was a success story from my perspective, but there are many other things that I tried that weren't successful, or perhaps just never went anywhere. Maybe they're dormant cells and they're going to have an upside in the next decade, who knows. But the takeaway for me is to always keep your pulse on many different projects. Consistent, low effort, input beyond your regular job. That's the way to really keep abreast of what's happening or likely to happen and likely to provide upside in the future.
I think that's very good advice. And I'm actually seeing a pretty strong correlation between the themes that you're expressing around, watching for opportunity where it comes up, continuous learning, and then, taking a swing, seeing if that's going to pan out and if it's not. And that's very similar to the way that I think innovation in the data space can often emerge, where we say we want to fail fast, but we also want to fail small, which means you've got to be doing several things at the same time. And I do know that Julie and Rebecca, who you guys know, are very interested in the types of AI and larger data set analysis that is emerging out there. So it'll be very interesting to see how that becomes part of everyone's day job. All right, so let's think about it from the company's perspective, right? So let's put ourselves in the corporate brain for a moment, recognizing that there are new skills coming in and that people are, there's a great deal of mobility for, talent, right? There are opportunities, this competitive labor market. What types of things would you like to see in place in order to encourage people to stay sticky to the industry, even if they're not entirely sticky to the job they're in at any given day?
So I think from my perspective, there are a couple of things, and I think these are more practical guidelines for managers. And ultimately, managers inform the organizational culture that we're in. I think it's really to be open-minded about different lifestyles and different personal and professional goals. As a conference that's focused on women, there are some natural transitions that a lot of women face, whether it's maternity, caring for elderly parents, maybe having much longer life expectancies without children. So all of those transitions, I think, are important as a manager to be open to, but also really have at the back of one's mind the fairness principle. I think those two have to be critically balanced. So the first thing really I would say is to be open and to be able to work with your team to help achieve both professional and personal goals. What I found in my career is I've been able to work with managers who I've been able to be very open about my personal goals with and also my professional goals. So they were very invested in helping me achieve both, because there is also this, in the background there is also a view that, okay, if I wanted to achieve my personal goals and shift away from the company or the industry, I was willing to do that. And I think that comes back to this idea of creating value, both internal to the firm that you're in, but also externally as well. And I think that, separate from that, just having a work culture where you are able to voice what you want to do versus what is expected becomes very important. So trust between management and teams and also peers, I think, becomes very important. One of the things that just came to mind is, I've been traveling in Australia and I've met lots of different people who have been traveling. And one thing that I noticed was a lot of people in their 30s, professionals, who are taking what they call an adult gap year. Now, for me, when I was in my 30s, like 2 decades ago, taking an adult gap year would have been career suicide. But these were people from McKinsey, Goldman, like people who I never would have thought would be doing this. And what was interesting to me is their adult gap year was not about a career transition. It wasn't about pivoting. It wasn't about not being employed. They just wanted to enjoy the fruits of their success while they were still young. And it just brought to mind this generational shift that has happened. So I think one of the things that workplaces should be doing is really trying to be on top of what the next generations are thinking about and what their preferences are. And I think a lot of that has also changed post-COVID when it comes to certain factors as to what will keep them sticky in the industry and in the firm.
I think that's a really good point. That resonates back to a comment that was made earlier, which is that we're never going back to exactly as it was before the pandemic. And this type of flexibility and kind of generational change. I'll tell you guys a little out story because I can't help myself. And I'm not at all proud mom here. My oldest son is graduating from college in May. Yeah, it happens. And he has a job. Yeah, that all happened too. And in the job he's moving to, after 5 years, they give them a 1-month vacation to a country that they've never been to.
Wow.
And they have a spending limit on it, which, as you should. But that model of just like the sort of, oh, I expect that to be part of, like, it didn't surprise him. I was like, what?
Yeah.
That's ridiculous. But yeah, it is absolutely getting to be something that's more normalized as that type of living life space. So what about you? You've had different experiences as well.
Sure. Yeah, I mean, sabbatical all sounds great, but it's definitely hard on the practical aspect. But I mean, look, it's going to be a tough day for middle managers here, but people leave the industry and they leave their jobs, survey after survey. It's the same thing every time. Why? Your direct manager. Like, it is the day-to-day experience that you have with your direct manager. Like, that is what happens. So from a practical standpoint, to think about retention, especially across some of these really important nodes in your life, whether it's, thinking about having a child, trying to conceive, thinking about an adoption strategy, taking care of a parent, actually going through a pregnancy, delivering a child, all of these different things. The reality is the outcomes are extremely varied for every single person, and it's really hard to make a one-size-fits-all solution to any of these things. That being said, this is what I would do. First, for middle managers, I think one thing that happens is you need to meet your employee where they are, and you need to anticipate their needs, maybe even before they do. It is their job to lead and to tell you these things. But for a lot of people, when they're having that very first conversation that is going to tell them, I am thinking about having a child, I am having a child, I need to drive my mom to XYZ appointment, it is going to be the most important conversation of their lives, probably, that they're ever going to have with their manager. It is that important. People practice it. I've practiced it with women who are going to go do this. And I find often that managers are just very unprepared for that. Their level, right, when you go in and you have that conversation, you're filled with everything and you want it to go well and your whole life is like in this moment. And your manager's like, I've either seen it before or I've done it myself, or I'm really worried because my team is gonna have to cover the gap. And having that reaction and having that first instance when you have an employee who's thinking about asking for an accommodation or doing something that's just quite normal in life, being there for them in that first conversation is the easiest way to retain an employee. If that conversation goes well, they will trust you for the rest of their career potentially. So I would definitely suggest that when you're thinking about middle management training, that you actually practice when somebody comes to you and is telling them that's clearly something very significant in their life. That's the first thing. The second, and to your point, is that a lot of these things actually require you to take time out of the office or require a schedule that is abnormal, right? It could be temporary, it could be on a more permanent basis. It could be that you're taking a leave of parental leave for men or women, adoptive parents. It could be that you need, again, to bring somebody to an appointment. You need to go yourself to an appointment. You're asking for something where you need to be off schedule. I think the biggest thing a manager can do is say, if I were in their shoes, would I feel comfortable doing that? Am I promoting a team that can include that person and their needs. And the reality is, I think if you did that, a lot of managers would say, ooh, maybe not. I would feel uncomfortable asking for the same treatment. And if that's the case, then it's time to get more creative, to your point. It's time to get way more creative. Change your KPIs. Think about your scheduling. This is like not that hard. There's tons of technology that we've all just experienced through COVID to try to change the status quo so that you can include these people on your team. The reality is replacing an employee is incredibly expensive. It's time consuming, Julie? It's less time consuming than it was prior to COVID. It's easier to interview. Job transitions are easier to make. But nobody wants that. I don't think any of these institutions want that long term. And so doing that is really important. And then I'm just going to throw it out there, but I don't know anybody who likes to be out until 9 or 10 at night to do the social parts of their job. Like, I don't know anyone who likes to do that, much less people with young children. So if you can think about ways to get the softer part of your team bonding and building done outside of like a 9 to 10 p.m. dinner, it's really, really critical, because having parts of your team miss out on that because the timing is inconvenient, it's not really fair, and they feel like they're missing out, even if, honestly, I've been to enough of these, you're not missing out. But it's New York, we're not working in London, 4:30, there's not that much going on a lot of these teams. Find another way to incorporate the soft part of the networking and the team building in a way that's approachable for everyone. Those are my 3 things I would do.
I love those because they're all practical, actionable, and relatable. And I also totally second the let's chill out with the 9, 10 o'clock dinners. It's actually one of the reasons that I personally made a career move into the Fed, is because enough already. I wonder, let's just talk a little bit more about if you could talk to your younger self, right? So think back to yourselves when you were showing up, pretty sure that you were going to take over the world any second. What would you guide them? What are the things that you think are most important that you've learned?
I'll let Alison start with that one.
I think on the questions coming up, it was, there was one question about what's the best advice that you got, or a piece of advice that stuck with you.
Yeah.
That was I think it's the last question, but I'm going to bring it forward.
As you should.
So when I was very young in the business, I came out guns blazing. I was super passionate. I just went to an all-women's college, and I was very gung-ho about changing the world. I still am. But I was really expressing it in a way that I am not now. And there was something transformative that sort of happened that made me change course. And just in the beginning of my career, there were lots of these types of events available to me externally and internally, and I found that they were all not progressive enough. And I don't know if that's anyone's experience, but it was mine when I first started. They weren't progressive nor aggressive enough on what I thought needed to structurally happen. And so I spent a lot of time being that person that outwardly expressed that, and it was known. And a senior woman on the trading floor pulled me aside one day into her office and said, "Alison, I gotta say it, but why are you playing games that you cannot win? You are going to tire yourself out. You are going to become exhausted." And I don't know if you've ever been in an argument with somebody and you try to tell them to calm down. But she told me to calm down, and I lost it. It has the exact opposite reaction, right? You ricochet, and you say, she doesn't understand me, she doesn't understand this world, she doesn't understand herself, right? All of it. And I kind of stayed in that quadrant of just resisting for a while. And then, I came back 6 months later to it, and I realized she was really right. I was spending an inordinate amount of energy on things that I could not control. And I was thinking about them, and it was in my headspace all the time. And it was taking away from the goal at hand. The goal at hand was to become the most successful as I possibly could at my current job, progress so that I got into a position of power so that I could hire, promote, retain lots of talented people, which surely included a bunch of women. That was the goal. And me focusing on this in a very big pie in the sky, taking on the world, was not useful to that goal at all. And so it really changed my point of view in terms of thinking locally and acting locally. it really, for me, then became about the people around me. How can I improve their lives? How can I improve the parental leave policies? How can I improve the things that are actually going to move the needle for all the people that I interact with personally every single day? And I still try as much as I can as a human to do that. So that was a huge point of transition. And I wish I could have talked to him. You know, I like that I was like rebellious, right? You like your former self when you were, you know, I wish I had some of her back. But it was a really instructive and important moment for me.
That's awesome. I really like that.
I know.
So I think my lessons for my younger self are slightly similar, but also slightly different. So I think the one thing that I would say similar is, and it's something that Nancy, who is not here, I believe, said in her speech at the beginning, was to ignore the noise. So at the beginning of my academic career, I was one of very few women, very few minority women. I was also one of the very few minority women at the IMF, and similarly on the trade floor as well. So I was very much hung up on the issues related to being a minority woman in these environments. And I remember just complaining to my mom about this. And she was just like, what are you talking about? My parents were first generation in the UK. They came in the 50s when you had Enoch Powell's kind of rivers of blood speech, which was very anti-racist, which was very racist, so anti-immigrant. And she was just saying, you have this great opportunity. What are you doing just focusing on all of this background noise? Focus on your job and focus on your career. So, and I think, I took that piece of advice, and I think that I would reiterate that to my young self, and even to many, many friends that I see in the industry now. Just focus on what you can control. I think the other piece of advice I would say to my young self, and I've mentioned this a few times, is your job is not the same as your career. Focusing on your job is great, but you also need to spend time on your career. And that is what is going to be a key marker for success in the long term.
I think that you guys have tremendously powerful insight into yourselves, your journey, and what people coming into the industry are likely to face. And I think that's great. I would give us some time to open up for questions for everybody out there. If you guys have some, that's great. Otherwise, we can certainly tell some tales, personal trials and tribulations.
Yeah, we have some questions, and just a reminder, anyone can submit in the app. So first, what advice do you have for people navigating their careers who are in between early career and where you are currently sitting? What questions should they be asking themselves as they look to move to the next level?
I think we covered quite a lot of this in the discussion. I really liked your framework, your 4 pointers. I think the real question is, are you taking enough risk? That's the question to ask yourself, because we can become very, very comfortable. And there may be very good reasons to be comfortable, whether that's you're meeting another professional goal or meeting another personal goal. But I think the key question to ask yourself is, are you taking enough risk in your career?
Yeah, I'd echo a similar point.
Thank you. And what are some specific workplace policies that have stood out to you that you hope would become the standard?
It's a good question.
Sure. Besides the 1 month.
The month, and they pay you?
Adult gap leave. Yeah, so parental leave has really changed quite a bit. And that is something that Joyce talked about in the beginning that was somewhat inspired by, not inspired, it was progressed further, I think, by 2020. And it is becoming more of an industry standard, both for men and women. So again, these are non-gender specific, but people talk about it as primary and secondary leave. Each business and each institution is going to talk about it in a different way. But really thinking about equalizing those. And again, this goes back to this, the question that the thing that I would do with managers, which is asking the manager to be in your shoes. Again, they're not gender specific, but disproportionately women tend to take more parental leave just by nature of actually delivering and being the birthing parent. That's what it's called at Google, actually, is birthing versus non-birthing parent. But the birthing parent tends to be women, and they tend to take more time off. And asking the secondary caregiver, besides it being good for society and family and all of these other things, to have equal buy-in to what that process of leave looks like can be very transformative for teams, because those individuals have to think about taking longer leaves. What does it mean in a sales role to step away for a full 16 weeks? What does it mean if I can't touch my book and the risk in my book? What does it mean that I have to give opportunities to some of the junior people on my team while I'm away and physically away? So I would say that that's something that's happened in the last 2 years that is becoming more prevalent sort of across industry, that I would hope becomes even more of a standard.
And who have been your role models and how have they influenced your career progression?
So I was lucky enough, do you mind if I take it, Sarah?
Please, go ahead.
I feel like you're going to have some heavy-hitting role models. So I was lucky enough to grow up with Joyce and people like this. But when you're first starting out, like, Joyce is not really in your orbit, right? Like, she's as accessible as they come. But generally, the way that I think about role models is to try to bring it back down to your level and people who can practically help you all the time. And so I'm a strategist, so I strategize. So there's this, for me, I always actually had a real framework and strategy around role models. And it was content mentors. I think about a content mentor as like the person on your floor or your team that just knows something that like no one else knows. They're so smart and they just are unbelievable experts in their field, and you beg, borrow, and steal to learn from them. Doesn't matter what it is, but like they're your people. One actually who's ex-Fed is this guy Seamus Brown at Moore. He's my person. He would never say that he is, but he is my person. Who like really had me grow up from a content perspective. The second one is an advocate. So the advocate is somebody who works in your business line who actually sees your day-to-day work. This is not like, it could be your manager, it could be like, I don't know, the ED on your team who's like slightly senior to you, it could even be a peer, but it needs to be someone who actually sees your work output every single day and can give you real feedback, not in the like corporate sense, in the, I didn't understand this note, please do this differently, you need to write this differently, I like fix this model, practically can help you with that. Double points if that person is willing to tell other people about how good you are. Adam Walker was that person for me at JP Morgan. Shout out to Adam Walker. Then the third set of people really that I look for in terms of thinking about someone to kind of look up to or look forward, it's like my 1 to 5 year crew. This tends to be women, and it's women who are like 1 to 5 years senior to me. So it's women who like are doing what I'm gonna do, and I can watch them, and I can watch them fail, and I can watch them succeed, and I can ask them how to help my kid read, and how to learn how to read, and homework, and like all of these things, because ultimately, like, I need that practical help sometimes. Raising young kids in this business is very lonely, like very lonely. And to have that network of people is amazing and super valuable. And there's a bunch in this room right now, so.
Those are great role models. I love them. I like the way you categorize them. Actually, my role models are actually my mom and my sisters. I come from a powerhouse family of 3 girls, and my mom is an amazingly resilient woman. And the reason why I always turn to them is because they help me look at my life holistically. So it's not just thinking about my professional side, but also how that marries and really sinks in with my personal goals and my life goals. And I think that's helped me a lot to think about different transitions and not be fearful about them, because I know exactly where I'm going. And within the industry, there are many individuals who I thank and I really look to for mentorship, guidance, and essentially really thinking through different career choices and career options. But really at the heart of it, my life role models are my mom and my sisters.
I love
Thank
that.
you for sharing.
You made the mistake of giving me a microphone, so I'm going to answer the question because some of
Please
them are
do.
actually in the room. When I came to the Fed 10 years ago, and I'd always been in the same space that most of you guys are, which is, you're one of one or two women in the room. It's, a fairly intense environment. And I remember one of my first meetings was with Julie Remache, Lori Logan, Patricia Zobel, and Anna Nordstrom, and Josh Frost was there too. But, but whatever. I realized it was notable because it was the first room that I had been in that was almost all women, and the level of, actually Susan McLaughlin was there as well, and you guys were actually talking about getting rid of a penny, what that would mean. So, flashback, this was like 8 years ago, how much it would cost to get rid of the penny. And first of all, it was an amazingly interesting intellectual exercise at the time, but it was just the level of discourse in the room and the amount of just listening and just interaction that was going on blew me away. And I realized that this is a hotbed of role models, is basically who's in this room now. And I just thought that was awesome, super awesome. So thank you, Julie. Thank you.
Next question. What's the most constructive way to discuss career progression and on to the next step with your manager?
I mean, I think for me, the way I've approached it has always been to think of myself in their shoes and help them to make a case for me and advocate for me. So, primary in that is there a business case? And if there isn't, find one. So, if I want to, take a year off, figure out what the business case for that is, for retaining me, for making it very hard to hire someone else like me. If I want to transition to go to and work in Europe, find out what the business case for that is. So I think being constructive in that dialogue and not just stating what you want to do and expecting them to figure out a solution for you is really critical. So if you are able to work with someone who already has your back, already values you, you're able to just give them the actual case for why they should be doing what you really think you want to do. So I think that's really important. Just see it from your manager's perspective and arm them, because they're going to have to make the case to their management and their bosses as to why they should be doing X, Y, or Z when it comes to your requirements.
Great managers and great institutions should not be in any way intimidated by the fact that you want to move up and on. So if you get a lot of pushback into those conversations, you probably should think critically about where you are. That's the first part. I think the second, it's always much easier if you have a vision for what your career is and you're trying to get your manager on board with what that is. It's much easier to do that if you backfill for yourself. So hiring great people behind you, hiring people on your team who are also ready to make that transition at the same time that you're ready to make that transition, you're basically just making the job very solvable and easy.
That is great advice.
Okay, maybe last question. Do you have any suggestions for people transitioning in later stages of their careers, feeling like they've reached a peak of one path and moving on to something maybe more meaningful?
I can take that. So I think, the suggestions that I have are, take some time out and just play and explore. So many of us think that there is one way of doing things or having a career and career progression, but just, if you're able to take some time out and just give yourself the bandwidth to explore different avenues, speak to many, many different types of people, there is a huge world out there. And even within the financial sector, individuals and firms are doing very, very different things. So just give yourself time to play.
I think I also have a bit of a response to that, because I have several people that I've worked with have gone through retirement transition, and retirement with a very small R, because I cannot believe that they've taken a lighter workload after leaving than they did before. But what I found is that there's what you do, right, which is your job and the thing that you're currently working on. And that's what's very visible and very obvious, I think, to people that are looking to hire you next or to do something, to engage you in some other way. But there's also who you are, right? So understand who you are. Are you a good networker? Are you just naturally, strategically, analytically inclined? You can learn anything, right? I mean, there's nothing that we can't learn, whether you're 50 or you're 20. So if you're interested in something, learn about it, apply it, do it. And then stay in touch with the people that, as you want to fill your day with things other than, fishing and pinochle, not that there's anything wrong with fishing and pinochle, that will give you the opportunities to do those things. So it's almost like the difference between, working and having a career with an employer and working and having a career independently. They don't have to be that different.
Thanks so much. That's our questions.
Great.
Well, what a great session that was. And I think all of us could find aspects of this that we could relate to. And I remember just Allison's comment, I remember my first child was 6 months old. I moved to JP Morgan and everybody said, it's crazy. This is not the right time to move. And it was right after the Asia financial crisis, which many of you are probably too young to remember. But I've been there more than 25 years now. So sometimes the best career decision you make, you can't necessarily know about the timing. So we're going to go right into the next session. And earlier today, we got a lot of questions on private credit, bank deregulation, and so all of these topics are going to be covered. I'm going to introduce our panelists and then come and join them in the conversation. So we're looking at private credit. What lies ahead. And I am very pleased to have two JP Morgan alumni on the session with me, but let me give you a little bit about their background and a fantastic moderator. So Colleen Kennedy is Managing Director of A.S. Birch Trove, and she leads all of their capital markets activities, investment sourcing, and fundraising for private credit strategy. She's held roles at JP Morgan in markets and investment banking. Emily Nicol is the head of private credit origination at AGL Credit Management. She was head of Barclays on balance sheet private credit investing. She also worked at Credit Value Partners and at Credit Suisse Asset Management, but started her career when she was much younger at JP Morgan. Fang Kai, who is the Assistant Director from the Board of Governors, so we've got different parts of the Fed involved at the Federal Reserve Board, is in the Division of Financial Stability, and she oversees the Financial Stability Assessment section, and that's responsible for assessing all the systemic risk that are arising from financial markets and institutions. So I'm just going to take a seat, turn the conversation over to Fang to Oregon to moderate the discussion.
Thank you so much. Joyce. Good afternoon, everyone. Welcome to today's last panel discussion on trends and outlook in private credit. First, I would like to thank the organizers, FRB New York and FIAZI, for hosting such a wonderful event and having me here joining the impressive panel of distinguished panelists. We have a lot to cover and a lot of interest from the audience, so let's dive right in. Let's start with a current trend in private credit markets. Joyce, there are different definitions and measurements of private credit market size. How does JP Morgan estimate the universe of the size of alternative assets versus traditional financial assets? And how do you estimate the size of private credit within alternative assets?
No, well, thank you so much. And so we identify 5 alternative assets. So let me just go through them and the size of each one. Private credit is actually the smallest one. So there's private equity, there's private credit, real estate, hedge funds, we heard a lot from today, and digital assets. Those are the 5 alternative asset classes that we write about. And they continued to expand last year, and that was actually led by digital assets recovering. So we estimate the size of that universe at $33 trillion. It was about 9% annualized growth. If you take a look at just the size that increased over the past year. Now, we think this is about 15% the size of the traditional market. So we have traditional assets at 180 trillion. So 104 trillion in equities, like 65 to 70% of that in the US. I mean, it's such a US story. And then 74 billion in fixed income. So it's about 15% the size. Now, people ask, where do I think this is going? And I will get to talking about deregulation. The way I look at this is you're still at the beginning for private credit because it's going to go global. You've got Europe, Asia Pacific, Latin America. You have sub-investment grade to investment grade to real asset lending that will be coming up. And let's just think about it. There are 18 million companies in the United States, and there's only 4,000 that are publicly traded. So I think the direction is really only going to go up, and if you're not going to get the bank regulation on top of that, so I think this is just the beginning, and is it growing too fast? What do we think? So if you look at the size of the asset classes, what is the relative size of this 33 trillion? So 1.8 trillion is what we identify as private credit. We have a little over 10 trillion, 10.5 trillion for private equity, 13 trillion for real estate, and 3.5 trillion for hedge funds, 3.3 trillion, which came back a lot for the digital assets, because that, of course, went down dramatically and then came back up. So it's the smallest of the alternative asset classes. We've also looked at things like the volume. And what we've seen is that the private credit trading volume went up by more than 100% to reach almost $300 billion, and that was a big increase. The LBO direct lending volume actually outpaced syndicated markets last year as well. I think one thing, though, that's a big trend in the asset class right now was that there was really not much difference between public and private credit returns last year, and you're seeing a real convergence of the spreads. So we actually think that private equity is going to fare better, even though that valuation has also collapsed quite a bit. It's gone from a 30% differential to half of that at this stage. But we actually think in private credit, and the returns were comparable. If you were buying high yield last year, it was high single digits. If you bought private credit last year, it was also high single digits. But the one thing I would say within the alternative asset classes about private credit is it's much lower vol. So when we look at the vol, it was just 8%. I mean, it was okay, you can say digital assets, but it's 72% vol. I mean, that's the unfortunate part about it. Or real estate has double the vol. But the returns were not really out of sync, whether you look at the U.S. or Europe, with the rest of the high yield market. So the amount of capital that was deployed by closed-end private credit funds was at 1.2 trillion at the end, in the middle of last year. That's the last numbers we had. So that implies that the amount of capital called for new investment was roughly equal to the amount that was distributed back to LPs. So I think that that some of these figures, are they as complete as we want them to be? I'm not so sure, but in the sources we look at, that's kind of the best way we would size the market.
It's the great thing about a private market. You don't actually know.
I'm not quite sure. And you've got the real two experts here.
Thank you, Joyce. So let's hear from Colleen next.
Sure.
So how do you see portfolio companies managing through the higher interest rate environment, and what indications of credit stress are you observing, if any, and how will that evolve if rates stay unchanged for the foreseeable future?
Sure. So most companies have really done just fine. They've really managed well through this interest rate environment, and they're still generating cash. Where companies have been caught, I feel like, is when their EBITDA has gone down, but not because they're paying more in interest, because the interest rate environment has created volatility in their business. So I think you can break this question up into two camps, macro and then micro. From a macro perspective, high rates have just created more volatility in business performance in general. We see cycles now more than when rates were zero. They're more frequent and more pronounced. And that creates EBITDA stress and really just volatility in overall performance. Now, on a more specific micro lens, perhaps we consider two buckets as well: regular way generic companies and then situations with a bit more leverage. Regular way companies are really performing well in the current environment with higher rates. And that's something that maybe the market hasn't caught on to yet. It's a question we get from investors, and the math is really simple. Take, for example, a private credit deal, 5 times levered, assume SOFR 500, so 10% is what you're paying. The math is very simple. 5 times 10%, 0.5. That just means half your EBITDA is devoted to paying interest. Further assume another 0.1 or 2 for CapEx. You're still generating cash. Now, you may not be generating as much cash. When interest rates were zero, only a quarter of your EBITDA was devoted to paying interest, right? But you're still generating cash. Whereas the macro does impact your cash flow. If there's volatility in your industry, there's volatility in your business, that creates EBITDA stress. Now that can put pressure on you. But the regular way company, interest rate itself isn't having as much impact. Then when you veer from regular way to more situations with more stress, that's where the interest burden becomes harder to cover. We're no longer talking about a 5 times deal, it's maybe 6 or 7 times levered. It's no longer SOFR 500, maybe it's SOFR 7, SOFR 8. That's when you start to see more PIK, you start to see more drawing on the revolver to pay interest, or even tapping a delayed draw in the structure to pay interest. Structural flexibility that comes from solution capital really helps to alleviate that stress. And without it, it becomes a lot more painful. And I think lastly, it's difficult to get a question on stress without mentioning defaults. And it's tricky in private credit land to think about defaults because a couple of reasons. One, it's less transparent in general than the public markets. And then 2, data methodologies and default definitions really vary wildly across platforms and sources. So I think it was something like S&P, Fitch, KBRA, there are several sources amalgamated together, 2 to 5%. So it's really not even that much more material above public markets regardless.
And I would say the question was really focused on existing portcos when they saw interest increase. I would say that overall leverage within the private credit space has come down relative to what we saw in 2019 and 2020 before the volatility, the interest rate volatility. Whereas in the liquid markets, I would say leverage has come up since then. So it's been a different reaction, but I would say structures can sustain it, to Colleen's point.
So what do you think is driving that trend of leverage coming down?
To accommodate for the higher interest base rates.
Okay, Emily, so what do you think is the driving demand? What is driving demand for private credit, and how do you expect competition between public and private markets, especially between BSL and private credit, to evolve? And what's the potential impact on spreads, credit quality, documentation, et cetera?
We probably spend the next 3 hours talking about everything that's embedded in that question, so I have some notes to direct me. So starting with the demand, I don't think we can talk about demand around private credit without first talking about something that I think Sarah mentioned in the first panel about the banks retrenching from parts of the leveraged loan market. That dynamic over the last decade has really created the opportunity for private credit to flourish and explode in the way that it has. Once we acknowledge that, then there's 2 other dynamics that had to come together for the demand to do what it has done. Both allocators of capital and borrowers of capital needed to find private credit an attractive asset class. And so to talk about the allocators of capital, when you think about capital formation on the private credit, in the private credit market, it's largely been driven by institutional investors historically. Increasingly, and we're going to talk about this on the panel, we're seeing retail investors enter into the market. Both of those really are attracted to the market given the attractive underlying risk-adjusted return. So what we're typically talking about, there's different subsectors even within the private credit landscape, and we're probably going to be going too far down the rabbit hole if we start to talk about the subsectors. The largest is direct lending, which is kind of plain vanilla, senior secured lending at sub 50% loan to value, and given where base rates are at today, at 9 to 10%. Unlevered annual returns. That unlevered is a key piece because a lot of our funds do use leverage, and so you are actually seeing the levered returns in the mid-teens. And so when you think about that being senior secured paper, where we have collateral and rights and remedies if there are defaults, that's very attractive, not only on an absolute basis, but on a relative basis when we look across other asset classes. So that's what the allocators are seeing. The borrowers, and Colleen touched on some of these points, the borrowers are finding it an attractive asset class and an attractive way to finance their capital structures, given a whole host of things, but I'll zero in on a couple. Speed of execution. Direct lenders, private credit is known to be able to move very quickly. We don't have to go to rating agencies, which takes a number of weeks, and then we don't go syndicate paper. So we can move much faster than the bank standing between the borrower and the lender. Price certainty. When banks underwrite loans to sell to the BSL, into the BSL market, the broadly syndicated market, they do so with flex, meaning because they're taking market risk on the timing to underwrite to syndicate, they have flex built into the pricing. Direct lenders are just pricing the risk because they are going to buy and hold it. So that price certainty, speed of execution, and Colleen touched on the fact that it's a flexible capital solution. What does that mean? We can offer PIK interest, so pay-in-kind interest. We oftentimes have very large unfunded term loans, and we don't, and this is not going to sound great, but we don't have the same requirements on historical reporting requirements, so we don't need to see 5 years of audited financials. No necessity of ratings, as I talked about. So it is a more flexible capital solution for borrowers if you don't fit into the box of what the broadly syndicated market is looking for. So that's demand. Competition between the liquid market, the broadly syndicated market, and private credit. I mean, it's been fascinating to watch over the past 10 years, but really even over the past 5 years, it's been really interesting to see the dynamic. When you first think about the direct lending market, direct lenders were targeting the lower middle market, and the banks were targeting the larger borrowers. And given the rise in demand and the ballooning of private credit AUM that we've seen, private credit can now really address these multi-billion-dollar capital structures. And so you have the ability for both markets to serve both sets of borrowers. So where do we stand today? I would say private credit, there's the part of the market that private credit is almost definitively going to serve, and that's, call it, sub 50 million of EBITDA. There's a part of the market that the banks are most likely to serve, which is, call it, 750 million or greater of EBITDA. And in between that, there's a lot of borrowers that fall between 50 million of EBITDA and 750 million of EBITDA. I kind of call this the gray area. And the way I think about the market and the new ecosystem between the banks and the broadly syndicated market and the private credit market is it's really a pendulum, right? Depending on the broader market dynamics driven by macro factors that we talked about in the first panel, this pendulum is going to go back and forth between borrowers favoring the broadly syndicated markets, which is where we are today, and borrowers favoring the private credit market, which is where we were in, call it, fourth quarter 2022, when all the banks were hung with a bunch of very large LBOs and their gates went up and they weren't really deploying capital. And I think the healthiest ecosystem is really when that pendulum is swinging back and forth and both are healthy in deploying capital and borrowers are making the best decision for their balance sheet and for their, the sponsors, making the best decision for how they want to grow their business. And so I think you'll see both existing. And so looping back to the final part of the question, which is what is the impact of this convergence on spreads, credit quality, and documentation? Historically, the private credit market has demanded, call it 150 to 300 basis points premium. Again, I think Sarah touched on it in the first panel. I love it when all the panels kind of connect at conferences. It means that maybe we know what we're talking about. This illiquidity premium. That is what the market has historically demanded. Because the broadly syndicated market is kind of firing on all cylinders right now, we're on the tight end. If and when market dynamics push the pendulum back to the other side, we'll see that illiquidity premium increase again. And so I think you'll continue to see the market operate within that. And I don't really think we'll ever fully converge on singular pricing because then there's just I think there's always going to be both. And I think private credit folks will always demand that premium to have the bespoke and the flexible capital. Credit quality, honestly, I don't see credit quality being correlated or impacted by the convergence of the two markets. There's always been a wide dispersion of credit quality among borrowers in the leveraged loan market. I think in private credit specifically, your ability to have competitively advantaged credit selection is really a function of your ability to originate. So it's further up. It's the top of the funnel. And I guess that's just what an originator would say. So I'm talking myself a little bit here, but I really think that both markets will see both credit quality across the spectrum. And then from a documentation perspective, the market currently has much looser documentation on the broadly syndicated side, just to level set, than on the private credit market. The private credit market does demand tighter documentation, and where we're really seeing that be impactful in today's market is around LME transactions, so liability management exercises. The private credit market does have some protections that flow through our documentation that prevent some of the very aggressive transactions that have been happening. Really, I think J. Crew was one of the first ones back in 2016, 17, 18, it all kind of blends together. And so I don't see the documentation converging completely as we've seen the convergence of the markets. I do still think we see two distinct sets of documentation, so much so if you have a hung broadly syndicated loan that gets syndicated to the private credit market ultimately, you do actually see those documentation comments flow through and you end up with a private credit document. So those are still two very distinct things. I hope that they remain two distinct things because I do think the BSL market is kind of living through the thick of it right now with LME transactions.
Thank you very much.
That was long. Anything else you would add?
Nailed it. Nailed it.
Yeah, thank you. For time's sake, let's move on to the next topic, an interesting one, about bank regulation and bank involvement. Joyce, what are your view of, or expectations for regulatory clarity with respect to private credit market? And what are your expectations for bank deregulation and the implications for private credit?
Yeah, so well, first I just want to say that agree with Emily and with Colleen as well. Like the default rate is convergence. It's around 2.5% for private credit. And if you even look at the recovery values, it's about the same as high yield. It's like 55 to 60%.
Yeah.
So you've had this convergence, but I think you're right. You're going to have this pendulum where you choose between it. It's not one or the other. And there is just the benefit of not having to do as much documentation. So I think this brings you to the regulatory question. The whole reason why this market originated to begin with was because the regulatory requirements were so onerous that this market developed. So I will first of all say that the opinions that I'm saying on this are my own personal opinions, not necessarily those of JP Morgan. So let's just start with Basel III. I think there really is kind of a scenario where this sort of dies on the vine. I mean, nothing that dramatic, but that it just kind of fizzles. And so there were efforts to advance the Basel III endgame that stalled. And if you even look at some of the things that are happening around the world, everybody's anticipating in other parts of the world that the U.S. isn't going to do anything, and so they're asking for extensions. So the UK Prudential Regulatory Authority announced that it was going to delay the implementation by 1 year until 2027. And there is this whole concern, I think, from European banks, UK banks, how are they going to be able to stay competitive? And when you think about this bigger picture, I mean, one of the things that has really helped the US exceptionalism was that after the global financial crisis, you had the emergence of private credit, which kind of filled this gap, which Europe never filled. So when you look at just, sort of the malaise in Europe, in part was that, that gap was not filled. So I think there is a scenario where you just, you don't have a dramatic announcement, but it just is something where you get towards more capital neutrality in the proposals, and there are extensions, and it just kind of withers away a bit. I think the other thing I would say on regulation is that there's a lot of scope for it, not getting rid of the regulation, like, oh, are you going to change Dodd-Frank and these, but just simplifying it, that, the hours and hours that were spent on stress tests, on the CCAR, on living wills, that it just becomes much less onerous. So it's not that it goes away, but what the requirements are. I mean, if you look at the pace of all of these executive orders that have been put out on deregulation, that there's just much less focus on it. So I don't think it is like a Project 2025 that, you get rid of the FDIC and let's say you merge it and you challenge the independence of the Fed. I think it's much more that you spend much less time on some of the processes. The Basel III endgame maybe just stalls and becomes something that not just in the US, but globally, everybody's going to look at what is the US doing on this. Do European banks want to be more disadvantaged than they already think that they have been? So on private credit specifically, I mean, the non-bank regulation just seems to me unlikely to advance. So that goes back to the pendulum, how much of that, and that you're not getting paid that much more right now. As you said, you're very much on sort of the tighter end of it. So I would say that. And I would just say that all of you have already probably parsed Bowman's speech as well, but I thought there was a lot in that speech. I mean, she mentions the SLR. She says that the GSIB, there should be some relief. And you can see that, swaps move, 10 basis points, kind of anticipating easier financial conditions. So a lot of the things that I thought might not happen until 2026 seem like they could happen this year. I actually thought there was quite a lot in her last announcement. And I think she made it very clear, even the wording that was used, that proactive regulatory measures are likely forthcoming, to ensure that dealers have adequate balance sheet, and that could, include amending the leverage ratio, the GSIB surcharge. So I thought there was actually quite a lot there in her announcements. The other thing I would just say is, I do think you're going to see LBO and M&A activity really rise from here in both the syndicated and the direct lending market. And I think you will see sort of make capital markets great again. I think there will be a boost to M&A activity and IPOs that was seen as reversing what was much more restrictive under Biden. And when I talked to our M&A group, they basically said, look, you have about 60% of CEOs that now think they're going to pursue some M&A activity this year, and that was like 35% in September before the elections. And so if you look at our M&A team estimates that global volumes reached about $3.5 trillion, so that was a 12% increase last year, so it could go up even more this year. And so I think I think just closing deals could be easier. I mean, last year you had a lot of regulatory scrutiny that was significant we estimate around 380 billion of announced deals, 250 of that actually closed eventually, but it took a long time and some of the deals didn't close. So I think you're going to see this boost to LBO and M&A activity. So to me, is private credit as attractive in valuations as it had been given the comparison? But then there is what's the risk on the other side down the road, right? I mean, so if I can get 5.7% in US high grade, and I'm expecting 7% returns for traditional assets, and I'm expecting 9% for private credit, how much is it worth it, at this stage? I mean, and that's why I think it is going to be this pendulum. It's not going to be, one way. Right now, I would rather have private equity than private credit, just given where the valuations are. But so I think that's just a little bit the way we think about where the regulatory environment could be going.
Thank you. Thank you for sharing this perspective. You mentioned the M&A activities. I want to ask Colleen, is a looser regulatory environment expected to generate meaningful M&A activity and associated debt financing?
Well, first, to echo Joyce's point, the sentiment is definitely that the M&A environment improves in 25. Not without its headwinds, of course, and I know we get into the rhetoric around tariffs later as an example, but in general, a lighter touch to regulation should boost M&A activity really across the board. We look at three main drivers of that optimism. The first, Joyce, you touched on this a bit as well, both strategics and sponsors have really been on the sidelines for a while. There's a lot of pent-up energy, and I think it was 2023 saw the lowest level of M&A action in 30 years. Then 24, we see equity markets have expanded, interest rates are stabilizing, credit spreads have come in, the bid-ask spread comes in, and now 25, post-election, there's some excitement that the new administration brings changes to antitrust. And that does two things. It unlocks the M&A activity for both strategics and sponsors who have been sitting more so on the sidelines. And two, it just instills greater corporate confidence in general. If you think the DOJ is not going to let you do the deal, it almost doesn't feel worth pursuing. That's not the case anymore. So maybe larger deals will be the biggest beneficiaries of that, but that sentiment can trickle down market as well. Two, private equity sponsors continue to face a lot of pressure to return capital to LPs, something like $4 trillion of capital they're sitting on right now. And for that reason, there's just a continued growing urge. We've been saying this for a year or 2 years at this point, but that clock is really ticking to distribute back and to give returns. It's either for two reasons at this point. One, you may have a fund with an investment period that's expiring at the end of this year, or just in general for your fundraising efforts. Those two are very correlated and hand in hand. And then lastly, the debt markets really are wide open, broadly syndicated market, fully functioning. There's a ton of dry powder in private credit. It's just a recipe for success for deployment. There's really no shortage, private, public, hybrid, you name it. Now, what makes us conservative about how big this could be, and this was brought up in panel one, I think as well, a couple things come to mind. Any bout of market volatility, of course, will delay some transaction uplift. That's reasonable. That's more of a timing issue. And then two, although we have seen cuts, rates are objectively still high, and that's, for debt-financed companies, that's still a challenge. So for that reason, maybe the sponsor activity still continues to lag a bit. But that's because debt-financed is a lot different than the stock-for-stock deals. High interest rates impact the valuation you're willing to pay. And that's the conundrum, right? The buyers are saying, hey, if I have to debt finance, it's more challenging to pay a full multiple. And the sellers are saying, hey, look at the equity markets, I should get a full valuation. But that's not new. That was around in 24, and we anticipate that to continue this year as well.
Yeah, and I think Colleen's bringing up a really good point. You know, there's M&A, then there's kind of corporate M&A, which is corporate to corporate, and there's sponsored M&A. And typically when we're talking about private credit, we're talking about sponsored M&A, not corporate. Corporate, it was actually up, I think I just said with regards to Barclays. I think the Barclays M&A team might have said that last year corporate M&A was up maybe 25%. Please, nobody quote me on that. And it was very low, you know, year over year, if not negative on the sponsored side. So very different dynamics happening in the two different markets. And we're hyper-focused on this one, which is where we're deploying our capital into. So just important for this group to understand that dynamic.
So Emily, in your view, how do you think banks are capitalizing the growth of private credit market? What are some of the opportunities and the risks?
Yeah, so look, I think the banks have seen this coming for a while. Yeah. You know, Goldman's been doing private credit out of, you know, their merchant bank and then their asset management businesses for 20 plus years. You know, as Joyce mentioned, I was hired at Barclays in 2018 to start a business to address the disintermediation that was happening of their traditional leverage finance business by private credit. And so The banks have been aware for a long time. JP Morgan, when I was doing on-balance sheet investing, was one of my biggest, competition when we were, private credit banking arms, going after opportunities. So, look, I think the banks are aware, and from my perspective, all banks need to do something. Why is that? It's because banks are inherently long origination, right? They have hundreds, if not thousands, of bankers across the corporate landscape talking to companies. And they're short capital. Typically, they're short capital for regulatory or just balance sheet from that perspective. So if you're a bank and you have to do something around an asset class because you don't want to be completely disintermediated, you kind of have three options. And this is coming from somebody who spent a large part of the last 5 years thinking about this. You can grow organically, either on balance sheet or through an asset management business. You can buy somebody, or you can partner with somebody. And so you see a lot of the different banks taking different approaches to it. And I think there's an Oliver Wyman report out, maybe dated October of last year, that announced 14 bank partnerships had been announced between January of 23 and October of 24. There's a handful more that have been announced since that date. So if a lot of the banks are choosing this partnership model, and I do think it's hyper important on that point to understand and acknowledge that all bank partnerships are not created equally, and they're all different and incredibly nuanced. I can't think of two that are actually completely identical in how they're approaching it. In terms of GP ownership, LP ownership, investment committee construct, legal and or commercial framework, all of these factors are going to be incredibly important in who succeeds in the partnership model and who doesn't. And so I do think banks are aware. I think that they're acting on that. And everybody's model's a little bit different. And we'll see who comes out successfully. I certainly have views on what you need to align in order to get to that place. JP Morgan's taking one approach, Goldman, Barclays, they're all different approaches.
Yeah, and I mean, the partnership approach and basically working across the financial sponsors is, I think, what I've heard the most about, but there are many different approaches that can be taken within that.
Yeah, and for what it's worth, when I'm out talking to sponsors, which is a big part of my day job, they really like the deeply integrated solution. And so I think that the partnerships that have figured that out or do provide that solution to their clients, which are the sponsors, are the ones that are going to succeed. But that's one person's view.
Thank you so much. Let's move on to the next topic, private credit's evolution as an asset class. Joyce, what's the addressable market size for private credit, and what's your expected growth? And what do you think of dry powder's estimate, and what do you think about the possibility of capital overwhelming the size of private credit investable opportunity?
So let me start with the dry powder, how we estimate that for closed-end funds. So we think it's around $430 billion right now. So that's the large, and about 60% of that is direct lending funds. If you look at the closed-end funds, 60% is direct lending, about 27% is distressed and special situations. And if you do a breakdown, it is about 2/3 of that is North America, and maybe 30% is the rest of the globe. So that's to start with the dry powder. Now, what's the investable universe? And this is where you can get, there are not very good numbers to begin with, but this is where you can get numbers all over the place. So let's think about it more conceptually. So let's just ask the theoretical questions that are being asked right now. Can private credit be owned in retirement funds? Will we change rules on that? Because remember that part of this was private credit was not accessible to your average investor. Okay, so we're at 1.8 trillion at sub-investment grade, but what's the universe of the investment grade market? I mean, like if we think there's 1.5 trillion of US high-grade corporate issuance, is the size of the investment grade market 10 times bigger than the sub-investment grade market when we think about comparing it to a traditional market? So I think this comes back to valuations. It also comes back to whether you have a higher default rate over time, right? We feel like you're not going to get that test this year, maybe not even next year, but by 2027, you could see perhaps some of those tests come up because it's still such a new market. But those are the kinds of questions you sort of have to ask, which is why every bank is really running to develop this, because it really is just beginning if you think about it in those terms. I mean, are we going to really think about it as an asset class, not just a way that you can get to market if you didn't want to go public and you couldn't access credit otherwise? So conceptually, you have to think about it, I think, very differently. So if we take a look at the capital raising activity that was done in private credit, last year for the full year, it was around 170 billion. So that was actually the third annual decline. That's about a third of a drop from where the peak had been for all the reasons that Emily had talked about. So and if you look at where the coupons have been coming out at about somewhere between 500 to 525 basis points for some of the private credit deals, it's okay, but it's not necessarily off the charts. So I come away feeling that the valuation piece of it is, you're going to have, just like the pendulum moves between the two, you're going to also have the valuations very much compared to each other in this high for longer environment that, I mean, I know the first panel, everybody thought that rates were going lower, but if I were on that panel, I'm probably in the higher camp, just because of how I look at the fiscal trajectory and what's going on. So I think the valuations will be a really big piece of it.
Thank you. So in a scenario of heightened trade tension environment, Colleen, what's your view of the sectors that would be most negatively affected?
Yeah, it's a good question. The short answer, I think in general, private credit should do well. Some sectors will feel it more than others. And I'd suggest maybe we consider a two-category framework here again. Physical goods companies more impacted, and then service-based companies perhaps less impacted. Generically first, the value of private credit, if we can take a step back, some of this is repetitive, but I think it's worth repeating. It can do what the banks cannot, and it can do it with speed and certainty of execution, and now with size, and it can lean into riskier transactions, right? The bank has limitations on leverage and rules it has to live within. So when the situation's a bit more dicey, it's more difficult for them to underwrite it. And in a heightened trade tension environment, right, implying more volatility in business, this is really where private credit shines. Because what the banks can do really well are the vanilla deals. And if it's tricky, right, they may not be willing to underwrite it, so they'll offer it best efforts. And what company wants a best efforts deal when the private credit market is wide open and writing large checks and not capped by leverage and can be really creative in solution without strangling you for cash? It can be a solution really where the banks cannot. So to sectors specifically here, yes, some sectors probably could fare better than others, and these are all very debatable. It's important to caveat they could go either way, but I think the two-category framework is appropriate. So first, harder for companies selling physical goods. Less impacted are those in the service area. Autos, for example, one of the biggest. Although assembled here, we import a lot. Retail, clothing, a lot of apparel comes from elsewhere. Chemicals, that's a global business, we import a lot. And then on the services side, think tech software, that's a lot of running code, developing products. Financials, banking, that's a service. Media advertising, business communications, really human capital heavy service-based businesses. All that said, it's a bit too early and it's difficult to tell because we don't know where tariffs are stopping and we don't know how they're going to be structured. But perhaps the two buckets can help us triangulate who's going to get hit the most. And now highly levered structures, I call out those with limited liquidity levers. Those are really going to be the ones that are impacted the most, and that's very industry agnostic.
Yeah, I think I agree with everything Colleen said, and that's the importance of having a sophisticated investment committee because it's really a credit by credit discussion, and not only is it a credit discussion, but it's a structure discussion because there can be an impacted credit that is investable with the right structure and the right parameters and the right boxes put in place to protect you should the impact of the tariff be greater than you thought it was going to be. So I do think that's important to note that even though there are sectors that will be impacted, they are investable. You just need to be very eyes wide open and structuring appropriately for those.
So what areas do you think within private credit sector are expected to grow the most in the coming years, and why?
Yeah, look, Joyce, named a couple of the different areas, the adjacent areas earlier, but I think, in the recent past, a lot of the growth has been concentrated in the kind of plain vanilla direct lending that I mentioned earlier. But given the fact that we have seen sponsored M&A volumes come down, there has been a rise, and all the talk of the town about a year ago was asset-backed financing structures and how private credit can get in there. We've really seen that develop over the last 9 months or so. And I'd say the areas that people are now talking about that I would expect to see the next 9 to 12 months be areas of growth would be infrastructure, project finance, jumbo residential mortgages is an area that my firm is not going into, but some private credit, and then higher risk kind of commercial real estate as well. And so those are areas, I think that, Joyce said this earlier, so I'm sorry to repeat, but I do think it's early days, right, in the private credit market. So I think you're going to see expansion beyond the plain vanilla direct lending. At some point, you'll see a big uptick in credit opportunities and distressed debt investing within the private credit world. I don't think that's in the next 9 to 12 months for what it's worth. I also think you're going to see continued partnerships, like ecosystem partnerships, essentially, right? Right now, it's banks and asset managers, but there are going to be other parts of the bank partnering on other products or different types of partnerships that emerge given the adjacent areas that private credit will grow into. So that's what people are kind of talking about right now, but I do think it'll continue to evolve as the markets evolve.
And how do you assess private credit's retail demand?
Yeah, I mean, that's been, with the rise of the BDC, it was historically, as I mentioned earlier, institutional investors investing into BDCs, and we've really seen with BCRED and HPS and a whole host of other BDCs, we've seen retail investors now able to access private credit. I think you'll continue to see that until there's a blip. And what's a blip? I mean, major outflows of a retail fund, given the fact that this is long-term, we're typically, this is illiquid long-duration loans, right? We're writing 5 to 7 year duration loans. And so when you pair that with retail flows, it's just going to be interesting to see how that plays out. We don't have a retail BDC, so I'll leave it there.
Okay, thank you. With that, I think it's time to open it up for questions from the audience.
Thank you. So our first question, what are some potential risks in terms of vulnerabilities in the market outside of what's already been discussed?
Well, maybe I can say and ask you guys to talk about it because I'm not a private credit specialist there, but I worry about liquidity. And so since I did sovereign debt and I'm sitting at the Fed and it's treasuries, we like liquidity, right? I mean, the whole thing that, illiquidity is so great and this makes it such a great asset class, always just gotten a little nervous about that. So I would actually love to hear from these two, how you think about liquidity. For private credit. And so I hear the arguments, well, look, the illiquidity means that you're not under pressure to market and you don't have to sell it. And so I see that you don't get the systemic risk because it's private credit, it's not mark to market. But I was visiting a pension fund and we were talking about 60-40. And they're like, oh, Joyce, 60-40 here means private public. I was like, ooh, that's not actually making me feel better about my 401k, and you're not even allowed to buy private credit technically. So I am more cautious in my view on it, given what my background is, which is looking much more at public markets and sovereign debt within that, and U.S. treasuries and other sovereign government debt. But I would love to hear both of what you have to say as far as what could go, because that's the key thing I would point out as far as the what could go wrong.
Do you want to start or you want me to?
I'll start. I think I have a lot of thoughts on this. I think it's true generally in credit that it's not the easiest thing to get out. And perhaps today there's some perception of tremendous liquidity in the broadly syndicated market that is fair in some ways and perhaps is overgenerous in some ways. In private credit, you're not going into this situation hoping there's a way out. It's just not apples to apples. You're going in trying to create, you're coming to the table, right, with a group of folks, usually a small group of folks, that you're going to weather with. You're going to create a structure and a leverage picture that makes sense so that the intention is not to get out. In broadly syndicated...
I understand the intention and the hope.
Yeah.
Yes, I get that.
I would mention, like, broadly syndicated markets, why does a CLO end up with a credit that's at 40? Like, that happens all the time, and it's because they couldn't get out. There is liquidity that is generated at a certain level, and arguably, perhaps, in private credit that exists more easily, if that's the right way to say it, because there's a pocket, there's a depth of opportunistic and distressed folks. Like, at a certain level, you can call someone and wake them up. It takes time. You have to educate them. Whereas in the broadly syndicated market, sometimes liquidity at par is tricky.
Yeah.
But I think the benefit to investors really is on the structure. You're really getting a better doc because you're going in not with the intention of trying to get out. And you're doing heavier diligence up front. It's all credit selection, right?
And I often will hear from colleagues, well, the liquid markets aren't liquid anyway.
Right, exactly.
Either. So,
no,
like,
right.
It's all, at least I'm getting paid more, but yeah.
Exactly. No, it's if you're getting 11.5 versus 13%, you're enjoying a little bit more return, and you have the better structure, right? It's both are true.
Yeah, I would also say it's important to keep in mind it's a fundamentally different business. We are relationship lenders, and let's not confuse that with portfolio management businesses at banks that are lending revolvers, and that is truly relationship capital, right? That is a loss leader typically for a bank. Our sponsors are our clients, and the sponsors that we're working with and deploying capital alongside, right? They're the equity and we're the debt. They care a lot about who the lenders are, and that's the toughest part about private credit is the originations and is the relationships and getting the call. And our clients don't want liquidity in the debt. And so it's really tough to talk about creating liquidity in the debt when the people who are choosing the lender group actually don't want that liquidity in their debt. And so that's a really unique dynamic that I think the market sometimes misses when there's these conversations about it. I also agree. I don't think there's as much depth and liquidity on the BSL side, and I do actually think there's a fair amount of depth in secondaries, like in private credit secondaries. That is an emerging part of the market, and oftentimes we see sponsors making those phone calls, right? So we have gotten calls from sponsors saying, hey, I have an LP that invested in this part of the capital structure, in this debt, and they are looking for liquidity, and you're a lender, or we want you to be a lender, we want to add you to the lender group. So that is an emerging part of the market, and I think that will continue to happen, but I think it's going to be at the discretion of the sponsors.
But then how do you think about just like ETFs? And where do you stop as far as like what are the vehicles where this should be, and if there isn't going to be regulation, just what could go wrong?
I mean, I alluded to that. I think there are some mismatches of fund vehicles and private credit sitting in those, and so I think we're going to see that play out. I don't think we've had the opportunity to see that play out yet, but there could be some mismatches in the market. I think vehicles ultimately will matter.
But I think it is a really good point as far as that you cannot think about it the same way as far as the lender.
Yeah, it's a fundamentally different market. And I think oftentimes we should be talking about the convergence of the two markets because it is happening. Yeah. And we should talk about BSL and private credit, but we should also acknowledge that they're fundamentally different. And I at CSAM had the benefit of sitting on a platform that had credit opportunities, direct lending, and CLOs and AGL. We have CLOs and private credit. So a unified platform is super helpful because you can see the different dynamics and really appreciate the different dynamics. And they're just fundamentally different, and we have to treat them as such. It happen to be the same loan structure, but that's about it.
Yeah, I agree with your point that this is fundamentally different, but do you think the retail investors understand the risk of illiquidity, and do you see like BDCs and or maybe private credit ETFs become popular? Is this risk getting
I think it's a great question that I'm not going to be the one to answer.
Okay, next question. Do you think we will see the development of a transparent secondary market for underlying private credit loans? If so, what does that timeline look like?
I mean, I'm happy to jump in because I have very strong views here. I think that all the banks want to be around it when it happens for all the reasons. They have deep infrastructure set up, they have trading desks, they have really knowledgeable employees. I don't see it in the near term. I don't think that the client base wants it. And I think that will it emerge in 10 years? It's hard to see how a $5 billion tranche won't have a secondary market. Will it emerge in 5 years? I don't know. Should it at some point? $5 billion is a large liquid tranche, or typically a large liquid tranche. But I don't think it's in the near term. What do you think?
Yeah, I don't have anything to add.
Yeah,
I think that's right.
Okay. As client demands are on the rise for private credit, do you anticipate a need for data transparency to improve? What type of data does the investor want to see?
You know, I love this question around data and this perception. I will say I think a lot of private credit funds mark to market their funds, and so there is a perception that that is not the case. I think all BDCs have valuation committees and very rigorous, procedures in place. So I do think that there's this misconception around the amount of work that is done. Private credit guys actually do more diligence and get more information from a sponsor on a private credit transaction than the broadly syndicated market. That is a fact. We actually have, information walls in place at our firm because if a sponsor is contemplating dual pathing a situation, meaning that they're contemplating a private credit solution and contemplating a BSL, there will be different information shared with each of the markets. Now, granted, there is a bank standing in the middle on the BSL side, and so we are not dual pathing alongside our colleagues on the BSL team. The bank is dual pathing alongside us, and then ultimately, if that's chosen, they will share information. But something like a quality of earnings report, we will get that, digest it. We will have calls on it. We'll talk to the sponsors about it. Whereas a BSL, a CLO business might just get the snippets of that quality of earnings report. So the information that the private credit teams are actually consuming and talking through with their investment committee is deeper, much deeper than what BSL folks are.
So I do want to say something about this. Like, I've heard this from every single person I've talked to who is an expert in private credit, but then why not disclose it? Because, like if you're writing the IMF Global Financial Stability Report or some of the things that the Fed does, or even I'm trying to put together cross-asset things. So I understand those arguments, which I'm told frequently, that look, if you look at what we have to go through and what our background is and that these aren't the same asset classes, but then it's not disclosed, so we can't even do numbers. So it's just a hard one if you're used to public markets to get your arms around.
Look, that's why fundraising is hard on the private credit side and why LPs care who they're investing and giving their capital to. So I think that is kind of the answer. They are doing a lot of diligence on the ultimate underwriting and the group doing that underwriting.
And if I may add one perspective, Birch Grove's private credit strategy, take a step back for a second, is more solution capital. So there's a whole pocket of private credit that is not closer to the upper middle market large cap, right? It's both to middle market and some large cap in certain situations. We're leaning into companies that typically are going through some type of transition. They may have an element of complexity to their credit profile or their story. So we're leaning into situations that mainstream and core direct lenders are not. We're less tied to the broader LBO market. And I would say our investors know what they're getting when they're coming into it. It's not this depth of retail, right, in this closed-end private credit fund. But I think the private credit market is vast, and particularly in solution capital, you are doing so much upfront credit work, and you are creating guardrails such that you come to the table before, if there's an issue, it really gets a life of its own. And then you have a better recovery in the scenario that it doesn't go well because you have the structure that protects you.
Yeah. So I think a lot of the questions tie back to who's investing, right?
Right.
But they also,
and those are fair questions.
and they tie back to your point on the structure, because that is actually a key, a key point to make. We're good.
Are we good? Okay, so this brings up to the end of the panel. Thank you to all the panelists for sharing their insights.
Thank you, Frank. Thank you.
And thank you for the audience for participating.
So I'm going to welcome Julie Remache back up here for the closing remarks. Julia is, as I mentioned, the Deputy SOMA Manager, the head of the Markets and Portfolio Analysis on the Open Markets Trading Desk in the Markets Group. And she has just been a tremendous partner with us in organizing this whole event. And also really want to give a round of applause to just the amazing staff and team, like Anne, who's been kind of on the phone with us daily, Maylene, who's worked on it, for emceeing it. And I also want to say that, all of this originated from talking to the men in the communications group at the New York Fed first. I see Connor sitting back here, that I gotten a call from them and they said, oh, well, Joyce, do you know Fiazi? I was like, yeah, of course. And well, what do you think? I said, well, the one thing I've worked on there is this women in fixed income. Is there something we should do? And this is kind of how it originated. And I see a number of men here, and I just want to say that it's a women in fixed income conference, but as you can see from the content, what we've discussed, we really want it to be a very mixed audience. So thank you, Julie, just for everything you've done in helping us with this.
No, thank you, Joyce. Thank you for that introduction. Let me start by thanking you and also Fiazi for the partnership here. I'll also recognize my colleagues and yours as well that have helped in organizing and bringing this together. If we could just pause and just sort of give you a round of applause. This conference really is a valuable opportunity for us to share ideas, to seek advice, and to build connections. I hope everyone has been able to experience that today. These are really elements essential to our professional and personal growth. We heard that in some of our discussions today. It's also an incredible opportunity to engage with accomplished and inspiring financial market professionals. I want to thank everyone that's joined us today, both in the room and also online, building on the success of last year's event here, co-hosting with Fiazi, but of course,
next year's event
on the prior years. Yes, and I do as well.
Okay.
I especially want to thank our excellent panelists for sharing their views, insights, and time with all of us today. It was really, I think I'll echo a point Emily just made in the last session. It's a sign of a well-constructed agenda and, such insightful and qualified individuals when you see all these connections across the panels, and I think that came through clearly. It was really so interesting to learn, Nancy, about your journey, and I was especially inspired by the way in which intellectual curiosity drove that path. So thank you for sharing. And Amanda, thanks also to you and to Lupin and Allison for sharing and giving us all such tangible advice on how to think about managing one's career and supporting each other. Again, a theme of continuous learning, but also on taking risks. I really came away from that. We had really excellent discussions about markets today, right? I heard in our first panel this focus on, resilience in terms of the outlook for the U.S. economy as we're coming into the year, but also so much nuance in terms of how to think about the year ahead. And I thank everyone for sharing those perspectives. As a central banker, understanding these developments, being part of these kinds of conversations really helps us navigate the path ahead. This last panel, learning so much about private credit. There's so many details here. Thanks everyone for sharing that expertise. It was really interesting to hear about the sources of the demand, the considerations around origination, how that relates to public markets and the aspect engagement with banks, et cetera. Really, really fascinating. So these conversations, these discussions really speak to the notion of continuous evolution that we see in financial markets. Conversations, as I said, like these really help us better navigate as the economic and financial landscape changes, financial market landscape changes. This is a theme that really impacts the work that we do here at the New York Fed. And I'd like to just conclude, if I may, by offering some thoughts along these lines, reflecting my time here at the bank. As with others, before I continue, I have to note that these are my views and do not necessarily reflect those of the Federal Reserve, Bank of New York, or the Federal Reserve System. I realize I stand between us and drinks, so I will bear with me. Thank you. Okay, as everyone knows, a core responsibility of the Federal Reserve is to conduct monetary policy to achieve its dual mandate of maximum employment and price stability. To do this, the FOMC sets the stance of monetary policy, including to establish a target range for the federal funds rate. Two crucial responsibilities of the open market trading desk here at the New York Fed are to collect market intelligence and to operate in markets to implement the policy directives of the FOMC. As Anna emphasized in her opening remarks, the market intelligence we gather through outreach and the insights you share at events like this plays an important role in helping us understand financial market developments, which in turn helps us to provide market analysis to inform the policy decisions of the FOMC. These discussions help us monitor and assess real-time developments and structural changes in financial markets, and also inform us in refining our approach to monetary policy implementation. Given that markets are constantly evolving, if we, the Federal Reserve, are to carry out this work well, we must be flexible and adaptive. When I joined the Fed in 2000, monetary policy was implemented in a so-called scarce reserve regime, where we managed the overnight federal funds rate by adjusting the quantity of reserves supplied. That framework, which had been effective for decades, required tight control of the supply of reserves to maintain control of short-term interest rates. In the years during and following the period of the global financial crisis, policy implementation changed in a fundamental way. The Federal Reserve launched a number of emergency lending facilities to address acute funding needs and conducted large-scale asset purchases to provide monetary policy accommodation when the federal funds rate was at the effective lower bound. These policy measures led to a notable expansion of reserve, which required the FOMC to evolve its policy implementation framework from a system based on scarce reserves to one based on ample and often abundant supply of reserves, where the federal funds rate was steered via administered rates. This new policy implementation framework evolved further in the subsequent years. In response to softness in money market rates and to support rate control, the overnight reverse repo facility was introduced in 2013. This is a tool that allows different types of money market participants to invest with, or in effect, lend funds overnight to the Fed, strengthening the floor on the Fed funds rate. Then in 2021, the standing repo facility was introduced, also to support rate control, by allowing counterparties to borrow overnight funds from the Fed against high-quality collateral. The SRF serves as a backstop to address pressures in overnight funding markets that could spill over into the Fed funds rate, impairing the implementation of and transmission of monetary policy. Since June 2022, the FOMC has been reducing the size of its balance sheet. While the policy implementation framework has delivered effective rate control during runoff, we've seen the reemergence of some pressures in money market rates around certain balance sheet statement reporting dates and Treasury settlement dates, consistent with the normalization of liquidity conditions. Our analysis and outreach suggested that a morning SRF operation could help improve the efficacy of the SRF facility, of the SRF, since most repo activity occurs in the morning. With this in mind, the desk implemented a technical exercise over the recent year-end period, adding a second morning SRF operation to our usual afternoon operation, with the intent of investigating whether an earlier auction time would support more effective money market functioning and policy implementation during periods of expected pressures. Feedback from counterparties and market participants suggested that the addition of morning operations did indeed support smooth market functioning and helped limit upward pressure on repo rates around year-end. As we look ahead, the committee's communicated that it intends to stop reducing the balance sheet once reserves are somewhat above the level it judges to be consistent with an ample supply of reserves. The desk continues to monitor a range of money market indicators and market intelligence to assess reserve conditions and help inform the committee's thinking about when to stop balance sheet runoff. The Federal Reserve remains steadfast in its mission to support the U.S. economy by promoting maximum employment and price stability. Over time, the tools used to implement policy have evolved, adapting amid changes in economic and market conditions, and informed by the market intelligence that we gather. This flexibility helps ensure that policy implementation continues to be effective. To wrap up, I'll say once again, thank you to everyone for coming today and to our panelists for sharing their insights. Understanding this range of views driving markets and what might be on the horizon helps us evolve our policy implementation tools and processes, keeps the FOMC better informed, and ultimately delivers better outcomes for the economy and for the country. On that note, I'd like to invite everyone to please join me in the Liberty Dining Room on the first floor for the reception. Thank you.
Thank you, Julie. And if I could just ask the panelists to stay for a photo, like everybody else can.